there's just a lot more momentum in the U.S. economy.
There's no obligation for the Fed to take into account wider conditions.
The Fed speakers are going to be focused on that lag effect between policy tightening and actual economic impact.
For economies that are fighting inflation, a weak currency is a problem.
This suddenly more hawkish tone, it's pretty confusing. It's confusing not only for markets, but just generally, globally, and for other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The most important jobs report since the last one until the next one from New York City. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures on the S&P 500 just about positive on the S&P. TK, the number we're looking for, 195K a little bit later this morning.
This morning, we'll bring that to you. Michael McKee leading the way. And John, the last 3 days have been as bizarre as any I've seen between the Fed press conference, what we observed with Governor Bailey, his interview with Francine Lacroix, and now on to where the markets are before this report. I love what Michael McKee told me this morning. In the tech austerity that we see, we're seeing freezing, not layoffs. Maybe that's the distinction of the job gloom this morning.
We're seeing freezing at Amazon, Tom, layoffs elsewhere, at Lyft, at Stripe, at other companies
I agree,
too.
there's a distinction.
And I think we're all asking that question. We can see it as we look around. We're not seeing it in the data yet.
Yes.
Same when it comes to inflation too. What's the lag time between seeing it, Tom, and it showing up in the data?
It's ex post, but there's got to be, one of those 400 PhDs that Jerome Powell has at the Fed. They've got to be watching the news flow that we see in the financial press this morning.
Got to get to the price action too. Here's the number of the morning, -60. Lisa, twos, tens, -60 this morning.
If you believe that this is a yield curve that really portends the potential recession ahead, it is flashing some serious red signals. How much can we see the steepest inversion going back to early 1980 and getting steeper and steeper in an inversion in a way that we really haven't seen so far? What does this mean about the depth of whatever is coming?
I did the math this morning. You can do it off the Bloomberg terminal. I took a conventional moving average. I look, and here's what I can say, John, I can't imagine I'm saying this. The twos, tens inversion with the twos yield coming up is now beneath, the inversion is greater than the moving average of the Volcker double recession era. I never, ever thought I'd say that. Priya Misra looks like a genius.
Well, let's start with the 2-year at about 474 this morning.
Yeah.
How much scope is there, Lisa, for that to go much higher from here? Citi is shooting for something like 5%. I think the most hawkish bank on the street right now is looking for the Fed to go to 575. That's Nomura. How much upside is there? How much have we priced in the bulk of this rate hiking cycle already?
Well, Jay Powell doesn't know the answer to that. And Jay Powell is concerned that it'll go further than currently markets are expecting, or at least that's what he wants to signal. You can talk about game theory and whether he's trying to play some kind of risky front and back with the markets. But right now, the market is pricing in 5.2% at the peak Fed funds rate next year. Do we get it higher? And a lot of that does depend on the CPI report that arguably will be the most important CPI report since the previous one until the next one. But how much do you get some sort of sense that we are still being surprised to the upside with the inflationary rates?
Is that our promo for the data? For payrolls and for CPI next Thursday. Let's get to the price action. Equity futures positive about 6 or 0.7% on the S&P this morning. On the week through Thursday, the S&P 500 down more than 4.5%. The Nasdaq 100 down more than 7% on the week so far, Tom. We could be heading towards the worst week on the Nasdaq since the start of the year.
It's the way it's down. There's like
ugly
down, and then there's ugly, and this is ugly down.
Yields backing away too, down a basis point on a 10-year, 413.32. And Lisa, in the FX market, euro dollar trying to reclaim 98, 97.75.
Yeah, it's funny how this is really something that seems like a moving target, and yet it really isn't, because it's always around between 99 and 97. At least it has been for the past few weeks. Today, very much front and center, the most important jobs report since the last one until the next one. Honestly, this will be important, but hard to know whether it's the headline number. Much more interested in what's underneath this. This comes at 8:30 a.m. How much do average hourly earnings point to whether people are just getting more part-time jobs versus more full-time, well-paying jobs? How much do we get some sense of the hours worked per week? Some of the granularity underneath may give a better sense of what's going on than just whether we start to, continue seeing 200,000 jobs being created every single month. At 9:30 a.m. Eastern, Labor Secretary Marty Walsh will be joining Jonathan Ferro, you, John, on the Open. How much do they really talk about this being a good thing versus a bad thing? It is a perverse moment where job creation is letting people feel a little uncomfortable with where we are in terms of how high inflation will go and what the Fed needs to do. Today, speaking of layoffs, Twitter is planning to tell about 3,700 employees, or half the company's workforce, they will no longer have a job. This comes again as we hear what you guys were talking about, these anecdotal reports that particularly in tech companies, there's some pretty significant layoffs. How do we get a sense of how this is bleeding out in the data? Because we're not really seeing it. We didn't see it in initial claims yesterday. We're probably not going to see it in the jobs report today. And at 10 a.m., we get Boston Fed President Susan Collins speaking at an event hosted by Brookings. How does she talk about where that peak Fed funds rate could be? John, exactly to your question about what we're doing right now, what we're seeing the potential for how high we can go. What's the balance of risks? When do they start to understand perhaps they need to hold and not just keep going in terms of how high those rates go?
Bramo, thank you. Great work as always. Lisa with the day ahead. Can we just take a look at the commodity screen this morning, Tom?
Yes.
Renewed hopes that China is about to reopen.
Yes.
And basically the whole of the commodity screen on the Bloomberg this morning is green. Brent crude 97, Tom, WTI close to 91.
Well, I'm going to do the banner right now on radio. You can see it. We migrate towards $100 a barrel Brent crude, the global price, not the American price. But the bottom line, I 100% agree, John. This is about Pacific Rim demand. Shout out to Jay Pulaski, who's called for this against the anti-science of China.
Well, he's been waiting for about 10 months for this to happen.
Well, okay, but we're all been waiting for the Chinese to get their vaccine act together.
Crude rallying up 2.5% on Brent. WTI up about 2.9%. Steve Whiting joins us now, Chief Investment Strategist, the Chief Economist at Citi Global Wealth Management. Steve, 8:30 Eastern Time. What are you looking for, sir?
Well, we're looking for continued gains in employment over the rest of the year. It's a deceleration. I think there's a lot of misunderstanding about what's happened. Employment since the beginning of 2020, it's grown all of 0.5%. But it's had 15 million swings, minus and plus, in the middle part of this. This is just upheaval and volatility, but it's the coming down portion of it now. What really matters is that businesses were catching up with demand over the past year. They were building inventories, they're raising production, they need employment for that. The problem is demand is slowing. And as we head into the coming year, we're expecting all of this policy tightening to hit. We'd expect about 2 million job losses net over the course of 2023. That's not going to be revealed here in a single month in 2022. So
what is the trend then on non-farm payrolls if you're going to have a 2 million job loss? I mean, do you get down to whatever the run rate is, 100, 150? Or are you suggesting a stream of negative statistics?
I think the negative statistics are next year. This is very unfortunate. Policy lags, the way they work. The simplest way to illustrate this is to think about the housing sector, where I can give you the simplest way of looking at it. If you think about what's happened to total construction spending or unfinished housing, it's fallen 2%. Sales have fallen 35%, because the problem is it takes 6 to 12 months to plan a construction project and deliver it. So what is being delivered now is coming from a time when we had a much lower mortgage rate and a much higher sales pace. Next year, the people who are working on building those houses don't have a new house to build, and they're going to have job losses. And it's going to be extended not just in housing, but in marketing, sales, trade, finance positions. So many things that have happened with over $150 billion buildup in real business inventories this year. So you're just taking a look at the economy that on the production side is catching up, but the demand side is heading lower because of policy. Now, the Federal Reserve recognized it in their statement, but we just have to realize here, higher unemployment is U.S. public policy.
Yeah, and Stephen, we're talking about how we're basically up at the 30,000-foot level in an airplane. We know we have to land. We just don't know how hard the landing will be. We were just talking about that 210s inversion. This is this yield curve that typically portends recession when it does go negative. It is the most negative since the early 1980s. Does that have any correlation with the depth of the downturn that you expect next year and beyond?
It will have some effect. It depends on the Federal Reserve. It's not just the rate that they will reach, like you mentioned earlier. It's the rate that they will sustain. What will the Federal Reserve do when we have self-reinforcing job declines? They're just not looking at that right now. The rate of inflation is too high. The problem is that the most stable portions of inflation that they focus on, core services, literally are a member of the index of lagging economic indicators, their strongest during recession. So you end up with a pro-cyclical monetary policy tightening into the recession and then pulling us out again and creating what I think is some needless volatility in the economy. You take a look at what's happened with money supply growth going from 27% now to 2%. In the coming year, it'll be negative. So the Fed is setting itself up, I think, to reverse some of this policy tightening. Unfortunately, they're going to wait until there's a good loss in the economy before that, until they're more worried about both sides of their mandate. And in effect, I think these job losses may lower the inflation rate maybe all of 0.5% in the coming year.
Well, that's the problem. Steve, thank you, sir. As always, Steve Whiting of City Global Wealth Management. Mark Ohana over at Bank of America talking about this morning. It's easy to pivot when unemployment's at 8% and inflation's at 3%. He goes on to say it's much harder to pivot when inflation is at 8% and unemployment is at 3%. And that right there is the problem. Steve's talking about when the mandate comes into conflict, maybe they'll back away. At the moment, they're communicating that they're not going to back away at all, even if the economy does roll over.
Not only one bank, but many, many of the central banks. And again, this goes to the degrees of freedom that are out there, run by $1 with a 112 DXI, make it 113. Shows strong dollar. I know, John, you're looking in Manhattan for housing this weekend. Bank rate 30-year new high.
Hey, I wish I could buy here.
To a new high 7.x%. There it is. We're back to a 2,000 30-year fixed mortgage level.
It's expensive to buy. Lisa, it's expensive to rent. And that's not just New York.
And this is part of the problem, right? Because that goes into the CPI, but it also goes into people's household balance sheets, what they can buy, and how the pain being felt among certain tiers of income is just tremendous.
John, I just do simple math. How many bedrooms, figure out the rent, and it's unimaginable what a bed costs in the island of Manhattan.
I'm with you. Futures right now positive 0.6% on the S&P, trying to bounce back from an ugly week of losses on the S&P 500. Payroll's a couple of hours away. Priya Misra of TD in the next hour on this yield curve. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The monthly U.S. jobs report is out today, and the question is whether the labor market is cooling enough for the Fed. A Bloomberg survey says employers added 195,000 jobs in October, and it sees a jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point rate hike next month. Donald Trump has sent the strongest signal yet that he plans to run again in 2024. At a rally in Iowa, the former president said that he will, quote, very, very, very probably make another bid for the White House. The rally was for Republican candidates Trump is backing in Tuesday's elections. Workers are suing Twitter over Elon Musk's plan to eliminate about 3,700 workers at the social media platform. Their lawsuit claims the layoffs are taking place without giving enough notice. The job cuts will amount to about half of Twitter's workforce. In the UK, Chancellor of the Exchequer Jeremy Hunt is considering cutting the tax-free allowance for dividend income. Now, it's just one of the options on the table. Hunt and Prime Minister Rishi Sunak are looking for $56 billion in spending cuts and tax increases. A big sale for Airbus. China Aviation Supplies has agreed to buy 140 of the European plane maker's jets. The list price is about $17 billion. Although discounts are usually given for big orders, most of the planes are A320 single-aisle aircraft. The announcement was made while German Chancellor Olaf Scholz was taking a visit to Beijing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Folks, look, this is a choice between, everybody talks about a referendum. It's not a referendum. It's a choice between two fundamentally different versions of America.
The President of the United States on the campaign trail yesterday evening. Someone else was on the campaign trail yesterday evening as well. It was the former President, Donald Trump. And this is what he had to say, Tom, in a rally last night. And now, in order to make our country successful and safe and glorious, I will very, very, very probably do it again. That's the closest the former president's come, Tom, to announcing maybe another run at this office.
We'll see. Very, very, very probably we're going to get a briefing here. We're all going to dive in and take notes with Anne-Marie Horton because we will be in Washington for the election. It's going to be interesting. John, what is it? Tuesday we're there?
Tuesday
and Wednesday.
We're there. And Wednesday too.
Okay.
Pre-game, post-game.
Pre-game, post-game. I like it.
Not that it's a game. It's serious stuff.
Yeah, it
Before
is.
people start writing in, I know.
Anne-Marie Horton is going to brief us. Anne-Marie, I want to get out front of Wednesday. I want to get out front of 9 a.m. Wednesday. We're like heading out to, Reagan to come back up north. Great. When they become new chairman, when, say, French Hill, who's a Republican from Arkansas, becomes, I guess, chairman of the Financial Services Committee, whatever, how does their lives change? How do leading Republicans' lives change Wednesday morning?
Well, they don't immediately, and we should note that we may not know every single district or state's final tallies by Wednesday morning. Many are projecting it could take a few days to count all these ballots. We already see more than 30 million in early voting. So in that part, we should note that we might not have the full picture of what next year's Congress will look like. The second part, Tom, is that nothing's going to change, obviously, until next year. So what you're going to see is a lame duck session until the end of the year. And actually, we heard Bernie Sanders, the senator from Vermont, talk about this yesterday. There are some items that Democrats want to push through, like potentially raising the debt ceiling, because this is something that they plan a showdown with for the Republicans at the top of the next year. You're yang me, but I mean, that's what it's going to be.
Truman was president.
I know, but it's
it's like a religious experience. We argue about it. Anne-Marie, seriously, why are we arguing about the stupid debt ceiling? They always raise it, right?
They do always raise it. It's this perennial debate that goes on forever. Right. At the end of the day, they get it done. You're 100% right. The reason why we're talking about it right now is because Republicans have come out and said that they are going to use it as leverage to get entitlement cuts. And now the Democrats are actually campaigning on that message.
Anne-Marie, John just whispered to me, would you ask about Trump? Okay, I'll ask about Trump. What's the likelihood the former president will take another shot at being president?
Well, this is what he said last night. Very, very, very probably that he will make another White House bid. Those are three verys. But we also should note that we had Kellyanne Conway as well yesterday speaking at an event, and she said he can announce a comeback bid, quote, soon. So this was really two hints that the former president is going to be looking. And also, was he really in Iowa campaigning for Chuck Grassley, or was he himself putting it out there? This is a very important state, obviously, for the caucus, putting it out there that he plans to make this announcement after the midterms.
I love the rhetorical question, Anne-Marie. Is this really him? And what do you really think? I'm sure that everyone's wondering and scratching their heads. Does this give the Democrats actually unwittingly a boost, or does it give the Republicans something of a boost just in terms of turnout and enthusiasm heading into next Tuesday?
Well, I think the Republicans, the Democrats, are going to use this, Lisa, as Trump's planning to make a comeback. He's in these states talking about a number of individuals, especially we do see a midterm election where there are election deniers on the ballot. Look at Arizona and Carrie Lake, who's leading in the polls to be the governor there. She's become this superstar of the, quote, MAGA Republicans. So you'll see Democrats point to these individuals, and as Biden will say, that is a critical moment in this election. At the same time, for the Republicans, a lot of them will be using Trump's, superstar kind of celebrity status when he has a number of campaign rallies he plans to continue doing. But there are others who as well want to distance himself. So it really depends who you ask. I think it puts Ron DeSantis most notably in the most difficult position, and Trump will be going to Florida.
I think he's the unhappiest man in America this morning off the back of that statement, to be honest with you, TK. AMH, you want to squeeze this in just quickly? Perhaps the biggest story internationally outside of the United States, Chancellor Scholz is in China. What is going on over there?
Not just Chancellor Scholz. Look at who he's bringing. He's bringing VW, BASF, a number of heavyweight companies. John, as you said a number of times, Germany is so reliant on China for their economy and really their growth. He's only there for a one-day trip. The most important thing that has come out so far of this meeting is that Xi Jinping has said he does not want to see nuclear warfare on the continent of Europe. And that was really, I believe, a direct line, a moment of him to signal to President Putin, do not go there.
AMH, great to catch up. Anne-Marie down in DC. All these conversations around China at the moment, TK, potentially reopening. You've seen the equity market in China this week. It is absolutely
People use the word
ripped.
frenzy. Seriously.
I think you can call it a frenzy.
Yeah.
You can call it a frenzy.
I see nuances here, and I think Enda Curran's been great. Steve Major the other day was great on the urge to get it open. And I'll go, and maybe it's an elitist thing, but I'll go to travel and monitor the air travel, and it appears to be loosening up.
That's what's fueling the move today.
Yeah.
So we started the week with a reopening rumour, and it is just that at the moment because it hasn't been confirmed as to whether this country at the moment has to put together a committee to assess whether they should drop COVID zero. That was the rumour at the start of the week. But this headline this morning fuels that rumour. Lisa, China is working on plans to scrap a system that penalises airlines for bringing virus cases into the country. This is our reporting here at Bloomberg, according to people familiar with the matter. But that just fuels the hopes, the rumours, Bramo, that maybe this is going to happen.
Especially in tandem, going back to what you said about Olaf Scholz heading to Germany with a bunch of different executives, and then announcing today, Olaf Scholz of Germany, saying that China will make BioNTech shots available to expats. Just there seems to be some sort of shift and reopening. These are the first meetings that Xi Jinping is having with a number of heads of state, including the one that's upcoming with President Biden. I just am really not understanding the sort of paradox here of saying, we recognize that there are new tensions. We want to move supply chains away from you. We don't want to be as reliant on you. And oh, by the way, Olaf Scholz also saying, we do not want decoupling. Well, I can't square that.
Germany's the weak link in that effort every single time, it seems. Every single time, whether it's Russia or whether it's China, Germany seems to be at the epicenter of that conversation.
Germany is not alone, though. And honestly, not to get them off the hook, but every Western nation might be speaking a hard line, and people are wondering whether President Biden is speaking a much harder line than he can really follow through on, and certainly the businesses, because they are still going over there and they are still courting Xi Jinping and Beijing more broadly.
Commodities rallying off the back of this. Equity futures up as well, up 0.7% on the S&P 500. Big day of gains ahead. That decision is at the mercy of what happens in the labour market. That data is coming up in about 2 hours' time. From New York, this is Bloomberg. 2 hours away from the payrolls report in America. Going into it, we're looking for something like 195,000 in the jobs report for October. That's the median in our survey here at Bloomberg of Wall Street economists. Futures right now up 0.7%. On the Nasdaq up 0.8%. On the Nasdaq 100 this week, we are down, lower, negative by 7.4% through Thursday. Could be on course here for the worst week, going all the way back to the start of the year. In the bond market, guess where yields have been this week? Moving the other way, higher, much, much higher, by about 30 basis points to the front end on a 2-year. On the week, on the session, up another 3 to 474.23, Tom. That is quite a move in this bond market.
I haven't even mentioned, John, are you doing the real yield this afternoon?
I'm not, no.
Oh, okay.
No.
Okay.
Katie Greifeld's going to fill in.
Very good.
Looking forward
Ms.
to that.
Greifeld's going to have a real yield of 1.74%. I think that's been undersold this week.
Two's tens right now.
From like roughly a 161 up to a 174 in the 10-year.
So that's 0.1. Let's do 0.2, and it's your point. Two's tens. Negative 60.
This is huge.
Negative 60.
Yeah, folks, you go back and there's been dip 1, dip 2, dip 3, dip 4 since the 80s. We're now through those. You know, there's no other way to put it, greater inversion. And again, we're back to the Volcker years there in 1980. I'll let somebody figure out to the 12-month period what it is. On Jobs Day, and it is an odd Jobs Day as it's been an odd Fed meeting and an odd Bank of England meeting, we are briefed by Rubila Faruqi, Chief U.S. Economist with Carl Weinberg at High Frequency Economics. You know, I look, Rubila, at your report, and I want to dovetail your sound market economics with what Nick Turner at our tech division calls the new tech austerity. Explain Jobs Friday with the tech austerity we're seeing in different shades from Lyft, Amazon, Apple, and the rest.
Good morning. Thanks for having me. We expect to see a shift in the labor market, right? I mean, we are looking at the layoff announcements, they're picking up. We're looking at the tech sector. We're looking at some shifts in certain sectors of the economy. But what we're really seeing is just not a broad-based, weakening in conditions. The labor market is still very tight. Demand for workers is still very tight. If you look at job openings, if you look at the vacancies to unemployed ratio, those signals, if you look at the layoffs, those signals are still very strong in terms of underlying momentum and strength in the labor market. Now, what do we expect to see? We've seen a rise in continuing claims over the last 3 weeks. We are watching for signals of a shift. But right now, there's nothing to suggest. We're looking for very robust job gains again this month, deceleration, but still very robust, and an unemployment rate that's really not coming off of a 50-year low.
Page 3 or page 4 of your high-frequency economics note always rips apart the 10-year yield and the yield curves and slopes that we see in fixed income. Take a negative 61 basis point 2-10 spread and bring that over to our job economy. How do you link those two together?
I mean, that's the difficult. I mean, the signal from the yield curve is one of recession, and it has been a very strong signal, historically very accurate. But we're not seeing the signals in the economy that we would need to see. Look at employment, look at production, look at incomes. And yes, wages are not keeping up with inflation, but wages are still rising at an elevated pace. And look at what's happening to real disposable incomes. We saw extreme negatives, and now we've turned positive again. So the signals that we would expect to see after this much of tightening from the Fed, they're just not there right now. That doesn't mean it's not going to happen. But really, recession is not part of our base case right now. We do think that this economy, this consumer, has positive momentum. Deceleration is the name of the game. That is going to happen. But we're just not sure that we're going to tip into negative. That's not our base case right now.
We just got through about 87% of the earnings season for the S&P 500 on a market weight basis. They're trickling in the finish. But have you seen some of these companies pull back on investments at a time when investors certainly are pulling back on any kind of material risk taking, since they're earning more right now in benchmark 2-year yields than they are many risky assets, with the earnings yield basically flat or close to it with that 2-year yield?
Yeah, and that's where there's sort of a disconnect, right? Everything that we would expect to see, in terms of profits and where investment is going to go, that's also not appearing, right? We saw business investment actually improve in the third quarter, but a lot of uncertainty surrounding outcomes going forward. We would expect that there would be an adjustment. There are a lot of headwinds, there are a lot of cross currents, but really no clear. If you look at company guidance, you do see that there are a lot of headwinds going forward, but it just hasn't appeared yet. And I do think that we're going to see an adjustment over the next few months and maybe going into 2023.
So does this data matter? I mean, or is it so backward looking that it can't really tell us anything about how quickly in the other direction we're moving?
No, you're right. I mean, the data is backward looking, but of course it matters because we do want to see what was happening, in the labor market, what's happening with inflation, but especially, the labor market right now, right? Because the Fed is taking action. They want to see, some softening. It's really not happening. So, but you're right. I mean, if you look historically, you can go from positive to negative, right? I mean, you just, as you move into recession, that positive numbers goes negative very quickly. There's just no sign right now that that's going to happen.
Rumila, long ago and far away, we hung I believe it was week, on the Challenger layoff statistics.
Right.
Are they still valid? Are they something you and Carl look at still?
Every little bit of information is valid, right? I mean, we do look at what we are getting in terms of, data from every avenue. It's just that there has been this disconnect.
Right.
We hear about, certain sectors. We hear about, like you brought up earlier, you talk about tech sector layoffs, but that has not translated into a broad-based weakening of the labor market. So yes, we're still looking, but the fundamentals are still very positive. There is still positive momentum in the labor market. There's still dislocations. Demand is still very strong. So it's very hard to say that when is this going to turn, when are these outcomes going to turn negative? And we just don't see that happening right now. But probably in 2023, that is probably when, when we're going to see the adjustment. We do see the unemployment rate going up. We think it's probably going to top out at 5%, 5%. But again, no indication right now that this adjustment is happening.
Ravila, one final question, because we've got to move on here with the way the markets are moving, particularly the inverted yield curve. I'm looking at the inverted real wage, and not to get calculus here, but the integran, the duration, the extent of that negative real wage is tangible. We have an election coming up on Tuesday. Is that really what this election is about? Is it after inflation adjustment, everybody's flat on their real wage back?
Yeah, I mean, we've been talking about this for a while. Real wages have been negative. Consumers are suffering, especially people at the lower end of the, wage spectrum. But again, we have other dynamics in play. We've got, as I said, real disposable income is turning positive. We still have, Fed research shows that there are still a lot of savings on household balance sheets. So, yes, people are paying more for rents. People are paying more for more for food and energy. But at the end of the day, I don't think that consumers are really seeing the type of stress that would lead this economy into recession, not right now. But in terms of elections, of course, that matters. And that's probably going to be, a big factor in the outcome next week.
Ravila, thank you, as always. Ravila Faruqi there of High Frequency Economics. Let's build out a couple of these themes and pick out one on the labour market. So we can see the pain in tech right now. Amazon freezing hiring, layoffs at Lyft, layoffs at Stripe. You can see it with the chip makers, Qualcomm freezing hiring, Intel cutting jobs, cutting spending. We've got to ask ourselves, is this a tech problem because that's where the excess has been for the last 10 years? Does that mean this is going to stay quite narrow, or do we have a broader issue?
Oh, yeah, that's the question. We don't know. I mean, I think everybody's got an opinion. But I think the answer, what Jay Powell would say, is we got to wait for the data.
Well, that's going to play into the whole debate around short and shallow, right? The consensus view is that this recession will be short if we get one, Lisa, and it will be shallow.
Yeah.
And that's because most people assume that we haven't had long enough time in this recovery, because they count 2 years, not the last 10 years before the pandemic, to build up the excesses to lead to a big, deep, prolonged recession. That's the argument at the moment.
A lot of it has to do with a lack of leverage in the household sector, right? You don't see the same kind of mortgages that are, 5% down payment and the rest just financed by cheap rates that suddenly people have to deal with. It's not the same kind of 2007 feel. That said, I was just reading a story about the housing market and how quickly it's decelerating, to Tom's point that he's been talking about. And if you start to get much slower pace of home purchases, what does that do to the broader economy? That is one of the key generators for jobs, for activity, for building, for home goods, all of these different things that have been such strong players in the post-pandemic era. I mean, how many sectors were really blown into some bigger state that are going to have to shrink a bit in this new reality?
We're not seeing it show up in the data, Tom, in a major way yet at all.
No, we're not.
And that's the issue for the Federal Reserve. I think they're emboldened by these lagging indicators to carry on hiking and keep on pushing.
The massively ex-post and what we saw from Bailey yesterday was stunning. John, we're forgetting the big event of the weekend, and I need you to explain this to me because
What's that? What have we got?
I was on the edge of the tots there. I was down when Sun scored 3 goals and all that, but the rowdy crowd at the tots in the end zone is nothing like at Liverpool.
The end zone.
Yeah,
you calling it the end
behind
zone.
the end zone. It's nothing like Liverpool. Explain how sanitized the Tottenham experience is compared to Anfield and what the madness up there.
Can I just engage my camera again before we start this conversation? Just quickly, if you get my single up. I have to do this every single day. I'm sorry that we're having this conversation. The end zone, anyway.
It's the end zone.
Sir Alex Ferguson, which was the former Manchester United manager, used to complain that the fans in the stadium were just sitting there eating prawn sandwiches and weren't taking in the game.
Yeah, okay.
I think the problem with the new stadiums, and I think modern day football in England, they've priced out the traditional fan.
It's so
expensive now. I was speaking to Mohammed the other day about the price of a season ticket at QPR. QPR's in the league below.
Right.
Something like £500 or something for the season. If you're in the Premier League, you are talking multiples of that for a top club. Thousands and thousands. So can you imagine trying to take your kids every single weekend to the game?
Lisa,
and they're going to be the people that make the noise,
We need to go to
right?
Liverpool to see. I think what he's saying is we need to go see real soccer.
I don't think you can price. I worry when you start to price out the real fans.
How about the 3 of us with Ian Shepherdson at Newcastle?
In Newcastle, now there's an experience.
I love you just went right over the
Christmas. Day after Christmas, Boxing Day, years and years ago, I remember going to watch West Brom versus Newcastle United. Freezing cold. Newcastle away fans, shirts off, Tom. Shirts off in the freezing cold. Real fans. Coming up, Tom Porcelli
in the end zone
of RBC. I'm letting that go. I really am. Futures up 0.8%. The jobs report just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. jobs report that comes out in less than 2 hours is expected to show that the labor market is still tight. According to a Bloomberg survey, employers added 195,000 jobs in October. Meanwhile, the jobless rate is estimated to have risen 0.1% to 3.6%. Oprah Winfrey has thrown her endorsement to Democrat John Fetterman in the Pennsylvania U.S. Senate race. Fetterman is trying to win a tight contest against Mehmet Oz, the Republican who is one of Oprah's former proteges. Oz is a celebrity doctor whose rise to fame began as a frequent guest on Winfrey's talk show. He later hosted his own successful program. In China, there's a sign that authorities are looking for ways to ease the impact of the COVID-0 policy. Beijing is working on plans to scrap a system that penalizes airlines for bringing virus cases into the country. Right now, carriers are banned from specific routes into China for up to 2 weeks, depending on how many COVID-positive passengers they carry. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
From the US's point of view, it's about tightening conditions in the US. The US economy is still doing well, so there's no obligation for the Fed to take into account wider conditions. There will still be repeated efforts to price in a Fed pivot trade through equities, through bonds, through FX, through the dollar and the like.
Jeff Yu, one of the very best of BNY Mellon, the senior market strategist, weighing in on this FX market. The market looks like this going into payrolls. We're higher by 0.8% on the S&P 500. The jobs report just around the corner, 8:30 Eastern time, looking for something like 195K. That's the median in our survey here at Bloomberg. Yields are lower by not even a basis point on a 10-year, 4.1374. Euro firmer, dollar weaker, 97.89 on euro dollar at 0.4%. The rumour mill gets more fuel over in China for a reopening, and this commodity market continues to rally. $91 on WTI. We're up by more than 3%. Tons of engagement on the football chat moments ago. Official correction, Tom. It was Roy Keane, the former Manchester United captain, not the manager.
That's a major correction.
Manchester
That's
United,
a faux pas of major level.
that coined the term the prawn sandwich brigade.
Okay.
I'm told by many people this morning. They were less concerned with your end zone comment and more concerned with the fact that I got that wrong.
That's because they know smart, adult, pro football, soccer idiot. That's the way it works.
I'm not sure that's how it goes, but seriously, they are like libraries sometimes, those stadiums, Tom.
Oh, yeah, we have the same problem here.
So
same
quiet.
thing. Hockey.
It's the problem.
Same way. Yeah, it's very true. Okay, what we're going to do here is do what Bloomberg Surveillance does best. We love to talk to people who've been wrong because we can study why they've been wrong and learn from it. For example, the great Binky Chadha with us at Deutsche Bank, who's had a bull call through the year, and maybe he's extending that into 2023. We also like to talk to people who've been right. Priya Misra, to join us later here, has been brilliant on curve aversion. And then there's Anna Wong, chief U.S. economist here at Bloomberg, out of the Chicago shop. And she has the economic call of the year is everybody. John, help me here. Nomura is out Anna Wong and Anna Wong this morning.
Nomura's at 550 to 575
right.
on Fed funds next year. That's a big call. Anna Wong on the team, and Anna's going to walk you through it now.
Yeah.
They're basically looking at their model, and it's saying 100% recession next year.
Anna, help us with a 5% terminal rate. Does the financial world fall apart?
Well, we think that, financial world react to expectations where rates are, right? So pretty much a 5% is priced in right now, and nothing's breaking. The mortgage rate at 7.1 is already basically pricing in that path. And we've seen, yes, it's clear that housing demand is falling sharply, but that's the kind of adjustment that is needed given how overpriced it is. So, and I think the population in the lower half of income are probably cheering that right now because a lot of people want to buy houses but could not afford to.
Yeah, I know out of Chicago, Anna, you got two dogs at home. One is named Long and the other's named Variable. Everybody's quoting long and variable lags from Milton Friedman. Forget about it. Let's go Gary Becker. What are the social consequences to America on this jobs day if we have rates revert and real rates revert back to what I knew in my youth? What happens socially to America?
Well, I think socially to America, what people care about will be revealed in the midterm elections that we will see next week. And what we are seeing in America is red versus blue states. And in red states, people are feeling very passionate about the issue of inflation, and that's partly because misery, if there's a thing called misery index, which is the sum of unemployment rate and inflation, and that index has historically kind of tracked midterm reactions outcome pretty well, and that would suggest that the misery increase in red states under the Biden administration has been bigger than the blue states, and that kind of underpins why there's so many angry people in the red states.
And there's nothing to anger people quite like losing their jobs, right? And that hasn't quite happened to the extent that people are predicting, and some would argue is absolutely by design in terms of the rate hikes that we've been seeing. Is your sense that there is credence behind that perhaps there won't be as many layoffs as people previously thought, just simply because businesses were burned during the pandemic, not being able to bring people back?
Yeah, I think the slow adjustment in the labor market right now is because right now we're frankly not seeing much adjustment needed to bring inflation down from the Fed's perspective. Well, the reason why is probably because firms are hoarding labor, and they don't want to go back to a world where they could not find a person to to man the counter, But I think that you can't. The Fed cannot have it both ways. You cannot have no unemployment and also inflation coming down, and that's because when output does slow, and we are seeing real GDP growth lingering around 0 to 0.5% for the next few quarters or so. Well, when output declines and you do not lay off people, that means that productivity is also rising. And when productivity is falling. So if productivity is falling, either the firms have to lay off people, which gets you back to the beginning of that circle, or firms have to pass on the higher unit labor cost to final prices, so you have inflation. So you can't have, I just don't see how you can have both low inflation and no firing happening in this dilemma that we have.
So far, we've really seen the layoffs isolated somewhat to the tech names in terms of how big they have been. What other industries are you watching? What other industries do you think are potentially vulnerable to these types of announced layoffs in the near term?
Yeah, so we looked at the sectors which are seeing the most significant declines in job openings, and we did see that it's isolated to sectors which had hired robustly during the pandemic. So they would be in sectors like transportation and warehousing, constructions, Wall Street jobs, and tech jobs. And if I had to tally all of them up, I think that the sectors that are vulnerable to sharper layoffs would account for about 11% of total employment, and so that's not a small number, but that's not a massive number either.
Anna, nobody's watching. Give us an estimate here. If we get an Anna Wong world, what's the unemployment rate?
We think that ultimately unemployment will rise to 4.9% in 2024.
See how she nailed that?
I know.
That was because she
knows her numbers, Tom.
Digits.
I assume that's what she thought you would lead with.
No, it was great. And then 4.9%.
Anna Wong at Bloomberg
Others
Economics.
are going higher.
I'm going to say thanks to Anna.
Yeah,
Anna, thank you. You can't fire what you couldn't hire. Lisa, how many times have we talked about that over the last couple of months?
How long does that last, though, for?
Sure.
I mean, at what point does the economy readjust faster than people can really stick with that kind of credo?
Yeah.
And the Fed's going to keep leaning into it every time we don't see these kind of cracks.
We're talking about the yield curve, and it relates exactly to this idea of corporate investment. Because if you think about this, if you're getting the most yield on a 2-year treasury versus a 10-year treasury that you've ever seen going back to the early 1980s, what does that make you want to do with your money? You want to stuff it in cash, and that is what people are doing. And that's a profound implication for a lot of these businesses.
I couldn't agree more. 2's Tom, negative 60. Negative 60.
Yeah, I mean, historically, that's a huge deal. Stuff it in cash. How can you insult a triple leverage cash fund?
I'm not. I'm basically saying that everybody's following your trend. You're avant-garde, Tom.
I'm very avant-garde.
I mean,
but they don't have a 2's20s payout.
Tom's on
10
trend.
years, but definitely.
Let's get to someone who actually nailed it. Priya Misra of TD.
Amen.
Up next. This is Bloomberg.
just a lot more momentum in the U.S. economy.
There's no obligation for the Fed to take into account wider conditions.
The Fed speakers are going to be focused on that lag effect between policy tightening and actual economic impact.
For economies that are fighting inflation, a weak currency is a problem.
This suddenly more hawkish tone, it's pretty confusing. It's confusing not only for markets, but just generally, globally, and for other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive 0.7% on the S&P 500. TK, the jobs number, 90 minutes away.
We got a little lightness here talking Tottenham and Liverpool. Forget about it. This is a serious report. We come off a Fed meeting that shocked, a Bank of England meeting that I felt was more shocking, John. And now we come to this jobs report amidst what Bloomberg calls the tech austerity of this Friday morning.
Off the back of an equity market that's been absolutely hammered, a bond market that's seen yields surge to highs we haven't seen since 2007, and a curve, Lisa, a curve that now sits at negative 60 basis points, twos compared to tens.
And people are responding as they logically should, which is they flood into cash. And that's what you just saw. You saw the biggest, you're on pace for the biggest inflows into cash funds going back to the second quarter of 2020 amid the peak of the pandemic. How much is this going to continue? And when does that take enough momentum out of some of the other areas of the economy where you start to see the pain that the Fed is actually looking for?
That's my favourite note of the week. Michael Hartnett of BofA with the flow data.
You did that. You put
Always
that on
enjoyed
Twitter.
that. Always enjoyed that. Crude's rallying today, guys. Brent crude up 3% to 97.50. WTI up 3.5%. WTI with a 91 handle. Tom, the China reopening rumour mill gets some fuel today.
Yeah, I'll go with that. And it's cascading. It's every day. There seems to be another little blurb. You wonder where this stuff comes from. It's got to come from the government. John, moments ago, the 10-year real yield rounded up. We went through 1.75%. That is remarkable.
Can we live with that? I think that's the question for our next guest, Tom. Can we live with that?
We're gonna do that with Priya here. But I would just suggest, folks, this is incredibly rich today. I went back and looked, John, 10% unemployment October of 2009. It's different now because the unemployment rate is so low. But the tension that's there today into 8:30 is genuine.
And the fact that inflation is not at 8% then.
You had that from Marty.
That's slightly problematic too. I'm going to whip through the price action for you just briefly on the S&P 500. We look a little something like this. Futures shaping up as follows, up 0.8%. Yields higher by almost a basis point on a 10-year at 415.63. It's the action at the front end of the curve. We're up 30 basis points or so on the week on a 2-year. Tom, that's quite a move on a 2-year yield to see it through 470 over the last couple of days.
Against the rate of change, it's the speed of movement that we're seeing there. And, into the election, John, can we say Wednesday morning, Tuesday morning when we're in Washington, can Joe Biden enjoy $100 Brent? It's feasible.
I don't think he wants that number going into the midterms.
But 97.47 on Brent crude and moving
in the wrong direction for them?
Yeah.
I think that's a good way of putting it. Bramo, WTI, $91.16.
Definitely something we'll be talking a lot about next week when we're in Washington, D.C. Today, it's all about jobs, as we've been talking about, 8:30 a.m. In about 90 minutes' time. We get that U.S. change in non-farm payrolls. Will it matter what the headline number is, if it's 200, if it's 190, if it's 220,000, or is it really going to be the wage picture? How much are wages decelerating in terms of how quickly they are rising year over year? This might matter more, just simply because it gives you more of a sense of where the pressure is, what companies have to do to lure in employees, and which employees are the ones that they actually want. Also, we're going to be hearing from Labor Secretary Marty Walsh, joining John at 9:30 a.m. How do they pivot to a constructive message ahead of next week's election, given the Federal Reserve has explicitly said that unemployment needs to rise in order to get inflation down? Today, talking about layoffs, Twitter is planning to inform about 3,700 of its employees, or about half the company's workforce. They no longer have jobs. This is, of course, an Elon Musk issue as he comes in and tries to cut costs. But how much is this a tech issue? How much is this a broader issue that has yet to feed into the market? John, you were talking about how is this just an isolated case because this is the area that benefited the most over the past 10 years? Or is this a predecessor to some of the job cuts that we are going to see, but not seeing yet? Certainly not in the jobless filings that we just got. And at 10 a.m., we hear from Boston Fed President Susan Collins at a Brookings Institute event. How much does she talk about the terminal rate? Right now, we are pricing in, and I'm really shocked by this. I was looking at the Fed funds futures, a 5% or higher rate for the majority of next year, pretty much the entirety of 2023. Have we priced in the implication of that, John, especially at a time when you do have this yield curve inversion that will only get steeper as we realize that type of level?
Lisa, thank you. Thank you very much. Tom, fascinating to see the Fed speak over the next couple of days.
Yes,
Do we
totally
see a split?
agree. Totally
Or are they all on the same page still?
Do we have a cumulative whatever
that leads into the statement and a group that leads into the news conference? Yeah, I'm with you. That's going to be fascinating the next couple of days.
Why don't you bring in her worship?
I plan to. Priya Misra, Queen of Rates.
Queen of Rates.
Queen of Rates.
All the year.
Head of Global Rates Strategy at TD Securities. Priya, great to catch up. 2s10s, very close to -60. I think it was a number of months ago you said we could test these levels. I think we're all trying to work out, Priya, whether we can push this much further than where we are right now.
I think it all depends on the inflation number. If the inflation number remains high, I think we can absolutely flatten further. I do think there's a limit to how much we can flatten because, at some point, the front end is going to give you the most amount of yield. If the labor market's strong, which we expect another strong report today, I think people move to the front end. And so where's that demand? Remember, the Fed's also doing QT. So I do think there's a limit to the inversion because there's a lot of supply that's coming in, 5 to 10 year part of the curve. And ultimately, that's what's pushing real rates higher. So I think we stay around here. But we can absolutely flatten further if inflation remains high, broad-based. I think there is some more room for that flattening.
Priya, I'm not going to do a log x-axis. I'm not allowed to do that on TV across America. But I will say this. If you get the Priya Misra world, does the short end of the curve begin to move out the duration? Do we go from a 1-year study to a 2-year study, a 2-year study to a 3-year study? Do we ebb out into longer duration?
I think it's hard to call the top in yields, but I think, you're supposed to start to look further out the curve. I mean, look at the move in real rates. In all the talk around how high the terminal rate is, I think what's being missed, you guys keep flagging it, but I think the market's missing that 10-year real rates are at 175. I mean, that's getting close to 2%. I think there are lags. We are all talking about lags. I would argue the lags are actually longer, not shorter, because the consumer has the savings buffer. The savings buffer is coming down. I think a high real rate is going to put pressure on the economy. You're supposed to start legging into duration. Is that now or is it early next year when we start to see the slowdown in the consumer? That's a harder call. But I think starting to take some duration risk as your recession hedge. Just keeping money in the front end is not going to be a great recession hedge once the Fed starts to cut rates. I think they're going to be late to start to cut rates. So you've got time to leg into duration. But I think, above 4% 10s is cheap, given all the tightening in financial conditions that we've seen.
When we talk about real rates, it's basically how accommodative or restrictive the Fed will remain over a very long period of time, and a question of how long the market will remain restrictive or demand a higher premium to borrowers, both corporate and government borrowers. Which market is not understanding a nearly 2% real rate right now in the 10-year?
I would say the government, particularly the U.S. government or any government with fiat currency, I think for them, real rates is not a big issue because they can always print their way out of this. It's the corporate sector. It's the housing market. I think that is responding to high real rates. Now, the U.S. has these long-dated mortgages that are fixed. So you may not see that in household leverage, and household leverage is lower. I do worry about the corporate sector. The longer we stay at these high real rates, you're going to see credit contraction. And that just takes a while to feed through into the economy. I think you start to see it in business investment starting to slow down. I think banks start to pull back. And ultimately, that shows up in a weaker economy. But these things just take a while. And I think the market's looking at, there's no buyer of long end fixed income right now. And I'm getting higher rates and just staying in cash. I think that's why you've seen this move in sort of the, what we call the belly of the curve.
And some people say, it's not going to be a credit crisis akin to what we saw in 2009. But is there a period that's analogous that we can point to in terms of what you expect to eventually get priced into the corporate sector?
Yeah, I think, the wall of maturity is really 2024, 25. That's where I think companies have termed out debt very smartly because, rates were low, spreads were tight. But at some point, if earnings start to disappoint, I think then as these companies start thinking about their debt burdens into 24, 25, I think that's when they actually start to curtail. And we're going to start to see job losses picking up. I think it's still very small. It's more a second half next year. So I think what the market's underpricing is Fed easing in 2024. I think they're going to stay resolute. They want inflation lower. We think you get close to 3% inflation by the end of next year, which will then allow the Fed to focus on the second part of their mandate, which is full employment. So those are the eases in 24, but I don't think they're going to give us forward guidance of this. So I think for companies, as they look out and they see these high real rates, it has to factor into their hiring decision, their investment decision. So we'll see more of that, I think, through the course of next year.
Priya, brilliant. As always, just fantastic and great call on the yield curve a number of months ago on this programme. Priya Misra there of TD Securities. Can you imagine if the Fed had an open conversation about what Priya just talked about, which is rate cuts in 2024? Can you imagine if they start, we're going to do this, but we're going to lean against it later on and we're going to cut?
To me, and I get it that there's money to be made and the money to be made lost on this, and it's a legitimate trading thing. But I don't think a bunch of economists are sitting around right now trying to figure out the magnitude of a pivot when the pivot comes. I mean, that's something new.
We're trying to work out, Lisa, the damage that will be done based on what's priced into the rates market already. And still the consensus is short and shallow. Still. And it's getting firmer. It's not getting a softer consensus anytime soon.
Well, that's what I was going to say. You're saying, can you imagine if the Fed said this? The market's pricing it in, and the market's expecting it. And so at a certain point, it doesn't matter what the Fed is going to say. This is what people believe and are trading on.
That's what he's leaning against in the news conference. He's trying to signal anything but. He's trying to push the terminal rate higher.
The last 3 days have been bizarre. Can we say good morning to Scotland?
Of course we can.
Fan calling, is it Celtics or Celtic?
It's Celtic.
The Celtic is
Celtic's the football team, sure.
The football, Celtic Dundee United.
Is that the game this weekend?
Celtic Dundee United.
You want to watch the Old Firm derby, Celtic Rangers, when they play?
Yes, I'm told it's big.
That's a real game.
He said Celtics is the best crowd.
Well, I'm sure Rangers fans might have a different opinion.
Is it the same as English football? Is it
it's a different league. It's a different standard now.
Same ball.
But I'd say the atmosphere is better.
They both have an end zone.
They both have an end zone. Good. That's right. Futures up by 0.8% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The monthly U.S. jobs report is out today, and the question is whether the labor market is cooling enough for the Fed. A Bloomberg survey says the employers added 195,000 jobs in October, and it sees a jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point rate hike next month. Donald Trump has sent the strongest signal yet that he plans to run again in 2024. At a rally in Iowa, the former president said that he will, quote, very, very, very probably make another bid for the White House. The rally was for Republican candidates Trump is backing in Tuesday's elections. Workers are suing Twitter over Elon Musk's plan to eliminate about 3,700 employees at the social media platform. Their lawsuit claims the layoffs are taking place without giving enough notice. The job cuts will amount to about half of Twitter's workforce. China's Xi Jinping met with Germany's Chancellor Olaf Scholz today in Beijing, and he used the occasion to send a message to Vladimir Putin. Xi told Scholz he opposes the use of nuclear force in Europe. Those were his most direct remarks yet on the need to keep Russia's war in Ukraine from escalating. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Uncertainty. Uncertainty is the enemy of deal making. And in terms of the markets and what's causing that uncertainty, clearly the Fed is way ahead of the midterm elections. I think if you look at the effect of midterm elections on the markets, the last 16 midterm elections have been followed by up stock markets 6 months and 12 months.
That's the market history from Ralph Schlossstein there of Evercore from New York. Let's get straight into this price action. Equity futures up 0.8%. The payrolls report coming in about an hour and 12 minutes from now. All the reopening rumors in China getting more fuel from several reports. Crude higher on crude, 91.39 on WTI, up by 3.65%. in the FX market. Euro dollar, a 98 handle. Weaker dollar here. Yields creeping higher again, though, on a 10-year by a basis point to about 4.16. If you're looking at a 2-year, through 4.70 in the last couple of days post-Fed. Right
Look what it is now.
4.75. Call it 4.76 if you want to round up 4 basis points. Going into payrolls, we're looking for 195K. Let's talk about jobs at Credit Suisse.
Yeah, it's not a tech company.
So
it's not
with
a
the
tech
overhaul
austerity.
of the last week, they announced plans of job cuts amounting to about 2,700. Denise Wee, here at Bloomberg, leading the reporting, indicating just moments ago that Credit Suisse is planning a fresh round of job cuts at the global wealth management business starting next week.
On top of the 2,700.
That's what this indicates.
Okay, the 2,700, folks, is 5.2%, which some people would say, I mean, I think Chanel Bassick would say that's sort of a end-of-the-year adjustment at a lot of Wall Street firms. But that's not what this is, John. This is part of this huge reorg.
This adds to dismissals that already started at the investment bank, according to people familiar with the matter. Credit Suisse, a spokesperson, of course, reached out to them, reiterated their plan to cut 2,700 roles, said it's underway, and declined to comment further.
And our allude is maybe that it would be more than that. Yeah.
The idea that it's spreading, the job cuts are spreading.
And
I'm not sure on the number.
In the spreading, Warner Brothers discovered we don't need to do it right now, but they made clear they are speeding up rapidly. They had synergies move, I believe it was from $3 billion out to $3.5 billion as they move in a tough entertainment
It's a
business as
difficult
well.
moment to reorg a bank, Tom, in a market like this one. It's never easy, but this is not an easy moment to do it in.
Are you liking the heat wave in New York? 70-something
It's warmer.
degrees?
It's warmer in Europe too.
Election, Washington, D.C. We'll be there on Monday, 79 degrees, basking in the November glow. Outside the White House is Anne-Marie Horton, and she joins us right now, Bloomberg Washington correspondent. The weather is unusual, and Anne-Marie, I want to open this up as we really begin with you, our election coverage. This midterm is unusual and comes to turnout. Do you have any sense if the turnout will be greater than the stunning number of 2018?
Well, the direction of travel is that we are seeing robust turnout, Tom, not just in early voting, more than 30 million, but also the fact that what the polls are showing is that it could match 2018 or even surpass that. Another interesting point, I was reading through the details of this morning from an analyst group, is the record amount of money ever spent on state and federal elections we are seeing in this midterm election. So there's a lot of money and there's a lot of people getting out the vote. And part of this is, we talked about this yesterday, especially when you look at suburban women who really came out in droves to flip a lot of House seats to Democrats in 2018. They are now very upset with the price of cost of things going up and inflation rates. This is their number one concern now. This is starting to shift. And the polls are showing more than 50% they want to get out and vote, and they say they plan to. So, and it's also warm weather, so it does look like it is setting up for this to be a very high number of turnout of Americans this midterms.
Anne-Marie, the consensus right now is that the Democrats will lose the House. What about the Senate?
Well, it's an interesting question with the Senate because it really depends what poll you look at, right? Because many say it's still a toss-up. If you look at 538, they're saying potentially it looks like they can win this and make it 51-49 Dems. But it's going to be one of the ones that's going to be very, very, very close. And that's really to be expected because right now the Democrats are in control, but laser thin majority, right? So this is going to be something that everyone is going to be focused on because pretty much everyone agrees that the Republicans are going to win the House. They are poised to. You even have some senators coming out talking about what they should do, Democratic senators, in the lame duck session because they think Republicans are going to really win the House. The House, the issue is the numbers. The Senate, it's still a toss-up.
Anne-Marie, how worried are they at the moment that the next governor of New York might be a Republican?
Well, I think they're incredibly worried. Who did we have there yesterday? The Vice President Kamala Harris and former Secretary of State and also presidential Democratic nominee Hillary Clinton going to New York to campaign for current Governor Hochul. This is something you really wouldn't see just days out from a midterm election. They are in deep blue New York. This is something that would be actually quite shocking if she was to lose this race. But Hochul recently said in an interview she felt like she was the underdog. She retracted a bit and said, I feel that way because I want to make sure that every campaign I'm connecting with voters and want to win their vote. But at the same time, what you have is from Representative Zeldin is something that is starting to really resonate with New Yorkers, which is the fact that they do feel like crime is going up. In New York City, you look at some of the MTA numbers, some subway crime is going up some 30%. And this is what is resonating at the moment in New York, on top of the fact that it is just more expensive to live there.
AMH, thank you. Anne-Marie down in Washington, D.C. Tom, if that doesn't speak to the weakness of this party right now, I don't know what does. If you're fighting up here in New York to keep hold of that, you've got a problem, haven't you?
Well, there's an upstate, downstate tradition here, and I would play this in, and folks, for our international audience particularly, this is not Hugh Carey, who was an iconic governor of New York with a whole sense of New York City, and, you think of, El D'Amato of Long Island as a Republican. This is Kathy Hochul from Buffalo, and I really wonder how... growing up in Western New York as I did, good morning to all that drink Genesee beer. Cream ale's wonderful. Ms. Hochul was weaned on Jenny Cream Ale. And the bottom line...
Why is this always about booze?
It's not... First of all, Jenny Cream Ale is not booze. It's a beverage of your choice.
Is it a light beer? What is
no, it's not like Coors 3.2.
Okay.
Don't you insult.
It's a question.
Please.
No, it's just a question.
The Whaley family would be insulted. The bottom line is the governor running here with all the trauma and how, Cuomo and all that, she's from Buffalo. And that's not really explained by the media right now. And each race is like this. There's nuance in Iowa and everywhere else.
I'm just pleased there's a bottom line. Do you remember the lieutenant governor used to come on this program with us and then
she
became
did.
governor and stopped speaking?
What
was that about?
I don't know. Speaking of beverages, this is great. I don't know if you know this. On radio, you can't see this, but I've been trying this. This is Tang Zero.
Yeah.
And I'm trying it out.
Came
it's
into the
actually
studio
pretty
this
good.
morning. You weren't here, Lisa.
Tang
you
Zero.
avoid these chats. And he says, Tang
right.
sent me the new Tang Zero. And I looked at him and I said, are you serious?
Yes, I am.
Are you serious?
He actually has
it's got the orange glow.
on his counter.
I mean,
you actually have a container of Tang on your counter at home.
I do, yes.
I didn't realize that until
Tang Zero.
Four-day losing streak on the S&P 500, going into payrolls, trying to bounce, trying to rally, up 0.7% on the S&P, up 0.75% on the Nasdaq. On the week through Thursday, the S&P 500 negative by more than 4%, the Nasdaq down by more than 7 percentage points. Potentially, if we close there, the worst week on the Nasdaq 100 going all the way back to January of this year. That's the equity story, the pain in the bond market. That's been a story of 2022. Your 2s, 10s and 30s year yields look like this. A 2-year just short of 4.75, the highest we've seen since 2007. The difference between 2s and 10s, the most negative since 1982. Tom, that difference right now in and around negative 60 basis points.
Can we say in honor of the chairman of the Federal Reserve System, this is all moving very, very quickly? That would be my statement over these chaotic 3 days.
Well, Tom, we all wondered whether he could open the door to a step down in interest rate hikes without prematurely triggering an easing of financial conditions. And if that was the question going into the news conference, I think he answered that. He can. He leant very hard into this idea that terminal rate is going to be higher. And we can talk about that in just a moment.
What else do you have?
I want to talk about this in the commodity market. If you open up the commodity screen on a Bloomberg terminal, if you have access, you'll see a ton of green. Here's some of it right now. WTI, Brent, copper, absolutely surging here. The why, Tom? Let's do the why. There is a conversation this week, the rumour mill, about China reopening. Yes. There was a rumour earlier this week that the government had put together a committee to assess dropping COVID zero. No confirmation of that whatsoever. But you start to get two reports, one from Bloomberg, one from Reuters. One from Bloomberg on opening up travel just a little bit more by dropping some of the penalties that they levy on airlines if they bring COVID into the country. And another from Reuters about maybe shortening the quarantine, Tom. And that just fuels the rumour mill. And I think it's fueling this commodity market this morning too.
I got Brent crude, and you've got it there, John, on radio, 97.86, up 3.4%. But we got a major folks pop. John, it is an outrage that John Ferro from the city is quoting Chicago Copper.
If you noticed, I didn't quote it.
Folks, let's get this straight.
I know.
To keep Ferro on the straight and narrow to 8:30, and Tom Purcelli will understand. You've got to understand, folks, there's two ways to quote copper, and on surveillance we do that. We look at LME
there's
copper.
There's one way to quote copper.
Thank you.
That ain't it.
We do London LME copper, 7,000 something, and then we have $3.58 Chicago.
This is for the third time in 24 hours. I'm sorry, London. Forgive me.
I know.
That's the cross-asset price action. Let's get you some single names, some movers. We can do that with Bramo. Hey, Lisa.
Hey, John. I will follow up, though, on the story that you were talking about with China and some of the rumors that have really fueled some of the rally. But first, I want to talk about earnings. What have we seen this earnings season as almost all companies, about 87% of market capitalization in the S&P 500 have reported? If you disappoint, you get penalized heavily. If you disappoint on the forward forecast, even more so. The examples today are PayPal down almost 7%, 6.6%, ahead of market trading after coming out with disappointing outlooks with expectations of a potential slowdown in the business. Twilio, a software provider, down 26% after their disappointment and after a forward forecast. And Kratos Defense and Security Solutions, which is not in the tech sector as much, down more than 10% after talking about supply chain disruptions and issues with the labor market. These are all different aspects of the same story that we keep telling, right? Software, hardware, tech in general getting hammered. How much is that a broader story? And then, of course, the areas that are more affected by labor shortages as well as some of the supply chain disruptions still feeling that pain. So how much is that a broader story and how much is that idiosyncratic for specific areas? On the flip side, to John's point about some of these rumors, in China, we are seeing a massive rally once again in some of these Chinese ADRs, the stocks of Chinese companies. Alibaba shares surging about 9.5% ahead of the market. JD.com, which is an online commerce site, up 9.3%. Yum China up 6.8%. Tom, how much can we really buy into these rumors, especially as Chinese authorities are trying to push back and saying there's no change. There's absolutely no change. And yet I do wonder what the signal is that Xi Jinping is actually being more outward looking, is going to places, is meeting with foreign leaders. Is that alone enough of some sort of statement in addition to all of the reports percolating out?
We'll have to see. The stories percolate out. And let's remember, Sunday evening, folks, eventful. Look for Asian coverage on Bloomberg Radio and Bloomberg TV, because I'm sorry, it could be really eventful from the bank, at least into Sunday. Look at PayPal, though, Lisa. You know, you talk about the tech wreck. It's down 74%. From the moonshot of the bull market.
We talk about the bubble and then the bursting. How much further does it have to go? And is there a broader ramification, or is this really an isolated area that got bid up during extraordinary times?
Right now, let's speed to Tom Parcelli, Chief U.S. Economist, RBC Capital Markets. Tom, I got a 1-hour conversation to squeeze in here. Give me the wage benefit dynamic right now that you and RBC see.
Yeah, look, things are slowing down. But you know, Tom, as I'm sure you appreciate, the moment you say things are slowing down, I think people just default to this collapse. I mean, that's not what we're talking about. I don't think that's where we are. I mean, we're looking for the sort of the nuances in the data, and the nuances are that wages are slowing. I've said this many times on this call. I prefer average weekly earnings. I think it's just a much more complete measure of wage dynamics. And if you want to look at that like on a 6-month percent change basis, which I think is the right way of looking at it, just because you can strip out the year-on-year stuff. The year-on-year is very wonky right now. So if you look at the 6-month percent change, it has slowed down. I mean, you're running at around a 3.5% pace. You're running as high as a 5.5% pace. So the wage dynamic is slowing down. But again, I think this is going to be a very slow grind into sort of this weak labor market. I mean, it's something we've been saying for a long time now.
How does Jerome Powell adjust to the slow grind you predict?
Yeah, so right now, I think it's a great question, because I think there are two ways or two boxes that they need to check, right? The first box, of course, is inflation. They need to see inflation slow down. He was very vague. He was asked specifically what he wants to see, and he was pretty vague about it. I'm sort of sympathetic to that, I guess, on some level. But I think by the time we get to the March meeting, I think inflation will have slowed down enough to basically put this hiking cycle on pause. So call it February, March, Fed pauses. The next box that needs to be checked, and this is for the people that are sort of desperate for the pivot. And I'm telling you, I hate this word. I've grown to hate the word pivot. It's just really, makes me want to jump out of my skin. But to get to the real pivot where he's reversing course, the next box you need to check is labor. And more specifically, you need to get to or near job losses. And I think that's probably waiting for us sometime around the middle of the year. And I think you check that box off, and I think that's when the Fed reverses course.
Tom, what could you be getting wrong? Because so far we're not seeing it at all in terms of a slowdown. And each surprise, inflationary-wise, around the world has surprised to the upside relative to expectations.
Yeah, definitely, Lisa. So, what can happen between, again, it's not like we're looking for job losses now, just to be clear. I mean, this is something we think is, at least 6 months away. So what could go wrong between now and the next 6 months where the labor backdrop really hasn't turned a little softer? If I knew, I probably wouldn't get the call wrong. I would say that the reality is the consumer is still sitting on, in the aggregate, Larry, I want to be very clear on that point. In the aggregate, the consumer is still sitting on a mountain of cash. There's obviously a lot of people that are completely tapped out. The consumer still has access to credit. Those two things can help buoy the consumer. And if the consumer continues to go down that path, then you could certainly see a dynamic where that mitigates any of the softness. But Lisa, again, just so we're again, you're asking me to sort of think about things that can go wrong. But relative to my call. But just so we're clear on my call, I've said this for a while now. If you look at, I like to look at net value add for corporate business. It's think of it as like sort of a proxy for profits in simple terms. It comes from the NIPA accounts, right, from the GDP accounts. When you look at that measure, this net value add corporations, in the first half of the year, it was running at around 11 or 12% pace. First half of the year, great. That's in nominal terms. Yeah. In real terms, it was down 2%. It was minus 2%. Think about what that means. The only reason why you actually saw net value add, this proxy for profits, actually in positive territory is because companies were able to inflate their way to profits.
And
Think
Tom,
about what that means.
I get that point. I get that point. That basically.
Go
ahead.
But sorry, let me just finish the whole idea. So what that means is that the volume of stuff is down, right? That's what it means when you look at real profits that were negative territory. That means the volume of stuff was down. So what's happened thus far in here in the second half of the year? Well, in the second half of the year, the volume of stuff continues to actually be down. So what do companies do to defend profits? Well, the classic way is to basically go after labor. So that's what we think is waiting for us. Again, I don't think it's get pernicious. But I think that's the path. Sorry, Lisa, but you were going to say.
Just really quickly, Tom, the Fed has been very clear that the balance of risks is inflation getting entrenched. And right now, it still has to be that, especially with the surprise. Just in 20 seconds, 30 seconds. Why do you disagree?
This is not going to become entrenched?
That's not the main risk that we're facing.
Yeah, look, I think that there's a lot of disinflation in the pipeline, right? I mean, I don't think that's not a guess at this point. I think the Fed has to say this because the moment they don't say that is the moment that they let financial conditions ease, and that's the last thing they want to do. Jay Powell will be the last person to acknowledge that labor has turned and that inflation is in a better place, and I have nothing but sympathy for that view. But that's at odds with what we see in the pipeline from an inflation perspective.
Hey, Tom, we've got to go. Wonderful as always. Tom Porcelli there of RBC Capital Markets going into payrolls. What Tom is saying is there is a difference between what this Fed wants to signal and what it actually thinks. And this is a question we're asking. When you look at the labour market right now, we see cracks all over the place. Don't see it in the data. Might see it later. Might see it in 50 minutes. Don't see it yet. Not in a big way. When we look at the inflation stuff, you see it in freight. Tom, you can see it elsewhere. We've seen it in commodities, select parts of it. Haven't seen it in headline inflation just yet.
I'm going to defend Richard Clarida. It is a single mandate message. They are fixated, as is Joe Biden and Donald Trump, on one thing, inflation.
Some select senators have a problem with that, Tom.
Yeah.
They quoted, they cited that line.
Round it up, $98 Brent. It's not going away.
Ronnie Krosner's coming up in a little bit. 8:15 Eastern time. We are 50 minutes away, call it 49 minutes away, from a payrolls report in America. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Oprah Winfrey has thrown her endorsement to Democrat John Fetterman in the Pennsylvania U.S. Senate race. Fetterman is trying to win a tight contest against Mehmet Oz, the Republican who is one of Oprah's former proteges. Oz is a celebrity doctor whose rise to fame began as a frequent guest on Winfrey's talk show. He later hosted his own successful program. A warning from European Central Bank President Christine Lagarde. She says interest rates may need to be raised to restrictive levels back to get inflation back down to 2%. And the ECB has raised borrowing costs by 2% in 3 months. Lagarde says the bank may have to take them to a point where they act as a brake on the economy. Apple could be shifting from its deep reliance on China. Sources tell Bloomberg the company's Taiwanese contract manufacturer, Pegagra, has begun assembling the latest iPhone 14 model in India. Now, that would make Pegagra the second Apple supplier to produce a smartphone in the country. The news comes after Apple's key manufacturing hub in China, operated by Foxconn, was placed under COVID lockdowns by authorities. And Bloomberg's learned that billionaire Jeff Bezos may take an offer from the National Football League's Washington Commanders. And music mogul Jay-Z, well, he could be an investor. The owners of the team, Dan and Tanya Snyder, say they're exploring options, including a sale. The Snyders are facing increasing pressure to step down. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Fed's saying we've been getting this so wrong for so long on inflation. We got to see the numbers. We can't anticipate the numbers. The Fed's still telling us we'll keep raising rates. Global growth is slowing. Risk aversion is pervasive. You're going to buy the dollar.
That's what people have been doing all year. That was Darren Mayer there, the HSBC head of research and FX strategy at HSBC. Your market looks like this in the equity market. Futures are up by 0.7%. The jobs number drops at 8:30 Eastern, so that's about 42 minutes from now. Yields are higher by about a basis point on a 10-year. On the front end too. Look at this on a 2-year. Yields up 4 basis points. 4.75 on a 2-year.
A true 4.75, no roundup.
Where were we 12 months ago? I'll tell you. 40 basis points. 40 basis points 12 months ago. 4.75 this morning on a 2-year.
Smartest guy in the block. You want a book to read this week? We can start with Fooled by Randomness, Nassim Taleb. He has one of the quotes of the year. The gravity is back in physics.
In a big way.
That's what you're talking about with a 2-year move.
Need to talk about the commodity market as well. WTI 91, Brent 97, and I tell you, Tom, pushing 98 now. Brent crude up by more than 3% on the session. The rumor mill around China getting some real fuel in the last day or so.
No
about
pun
reopening.
intended. I like that. Very good. You know, that seemed like the humor of Will Kennedy there.
No, I planned this stuff.
Getting some real petrol.
Will
Kennedy joins us now on hydrocarbons, and this is something all of you care about, including those towards a midterm election as well. Will, is it feasible at Brent 97, rounded up to 98, that we get $100 a barrel by Election Day Tuesday? Are we moving that fast?
I think it would take another big headline out of China to get us there, or something else, some kind of supply disruption. But it's clear that $100 is definitely back in the sights of the market. And as John said, this is being driven by China. When we look at the global oil market, the one source of weakness that has been consistent this year is China, where lockdowns have kept mobility under control. So that means less driving, less flying. If that changes, that injects probably several 100,000 barrels of extra demand, and it will tighten the market considerably.
And Will, an apology on the part of Team Surveillance. It was completely my fault. We quoted Chicago Copper earlier instead of LME. Ferro almost walked off the set in a tantrum. Will, it will never happen again. I'm sorry. But are they linked together? Is copper and the regular commodity lift, is it linked with Brent and China to $100 a barrel?
I mean, it's all part of the same picture. More than half of copper demand comes from China. It's the ultimate bellwether of the industrial economy, as everyone always says. A China recovery would be very good for copper prices. That said, it's more of an input into China's industrial economy, which has not been as affected by lockdowns as the movement of people around China and oil demand.
Well, it's November. We're tracking the weather as much as we are markets. The weather's been warm. People feel better. It still is a long winter ahead. How much would a China reopening take energy away from Europe, away from the U.S. at a time when prices are the foremost concern?
You're right to point towards gas as well. I mean, one of the reasons that Europe's been able to fill its gas supply, fill its stockpiles, one of the reasons why gas prices have fallen back a bit is because China's gas demand has been subdued. And of course, a stronger Chinese economy could change that quite quickly, Lisa. So yes, it's definitely something for people to watch on the gas side as well as the oil side. It could feed through into the whole energy complex. And it would only take a spell of colder weather in Europe before the narrative on gas prices change. One other thing to say about the energy crunch in Europe is we got another dreadful set of figures from France overnight about just how constrained its nuclear production will be. They're missing earlier targets. That sent gas prices higher today. A real sign that for all the good news we've had on gas and energy crunch in Europe, the winter is a long one, as you say, and we're nowhere out of the woods yet.
It's such a confusing picture with Europe because it's hard to understand or really give generalizations to where different countries get their energy sources. Natural gas in France, the nuclear plants. Is there overlap and substantial overlap in terms of the sources of natural gas for China and for, say, Germany or the other major economies?
Not Germany yet, because Germany, one of the problems that Germany's had in this gas crunch is that it didn't have the capacity to import LNG. But one thing we are seeing is the emergence of a global LNG market. That's a trend that's been happening for years. More LNG is traded on a spot basis, like the oil market, as opposed to long-term contracts. You see traders coming into the market. You see cargoes being arbitraged between Europe and Asia. So that's a world that is changing, and that's a world where energy events in one part of the world, the energy crunch in Europe, can have an impact on the cost of energy in Japan and China, and vice versa.
Will, an unfair question, but it's Unfair Friday. Do you and your team model that if China comes back to some form of GDP, call it 5% as a guesstimate, that we revisit 122.01 Brent crude?
I don't think we would model that. I do think that what I would say is there's a potentially very bullish mix here. We've talked about China. The other thing that we need to talk about is the impact of Russian sanctions, price cap. That's a big focus of the market right now. In early December, the European Union will stop buying Russian crude, and that Russian crude needs to find a home somewhere else. Now, it has been selling a lot more oil to India and China, but it's a real question whether those markets can absorb all that crude, and whether the logistical, the financial, the insurance aspects of that, finding the right ships, all of that can happen, or whether there are going to be huge snarl-ups and some of that Russian crude gets stranded in Russia. Now, you put that together with a China reopening, you put that together with pretty resilient demand, frankly, in the rest of the world, and you get a very bullish mix. One other thing I would say on demand, people talk about a recession and what it would do to oil. It takes a very, very deep recession to cut oil demand. It happened in the global financial crisis, sure, but most recessions just see demand grow at a slower rate. So I don't think people should necessarily assume that if we get some kind of economic slowdown in the wider world outside China, that definitely translates into lower demand. It could prove a pretty bullish winter if some of these things come together, Tom.
Hey, Will, wonderful coverage from you and the team, as always. Will Kennedy there in London. 91.50 on WTI, crude up by close to 4% on the session now. Brent crude right now close to 98, 97.90, up by 3.4%. Every single line of that commodity market, Tom, this morning, basically every single line is rallying.
Just since I was busting your chops 7 minutes ago on copper, it's lifted out to new recovery highs. Copper to 79.13 LME, and in Chicago 360.25. You got to quote both numbers.
Do you?
It's surveillance.
I'm just used to only quoting one.
Well, no, but my expertise on this, Lisa, is that if you're in the Dorchester Hotel at the mining conference with your senior executive producer, she asks for the umbrella in the cocktail that's gold and black in honor of Purdue. That's what you do at the LME conference.
LME Week is very cool.
LME Week was very cool. We observed it.
Trip.
I don't think it's as cool as it used to be.
Oh no, it's changed absolutely. Big time, it's changed.
Well, because you can't drink
but
as much.
You can't get a drink without an umbrella.
What do you mean, you?
Yeah, I'm just saying, you is in general.
You. Oh, it's a general you.
You cannot.
Exactly.
It's a general you.
Royal you.
Payroll is 34 minutes away. This is Bloomberg.
I wouldn't read too much into what the central banks are saying. right now.
Some doubts are creeping in, and I think that's where we are. This is really very different from where the Fed is right now.
The Fed's saying we've been getting this so wrong for so long on inflation. We got to see the numbers.
The problem is we don't really know where neutral rates are.
There is the potential that there will be more of a focus on the lag effects and a slower pace of rate hikes from here on out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We welcome you on Jobs Day in 29 minutes. And John, this is a Jobs Day, which is about 3 days. A Fed press conference, the stunning 2-year recession announcement out of the United Kingdom, and then on to some real data today. It's going to be amazing to see what Jerome Powell thinks of it.
It's been 2 hours. We haven't said it once. Is bad news good news today?
Oh, you're killing me.
Or is good news bad news? It's been 2 hours. We didn't mention it once.
You're just trying to trigger us. You know, he triggered you
I'm not
with
trying
the
to
end
trigger
zone.
you.
Well, I mean, honestly,
I've heard this week.
Okay.
End zone, the Dow, multiple
exactly.
times.
You're like, I'm done.
What's the end zone?
Yeah, the exactly.
In English football.
Wait,
Good
seriously?
news, bad news?
195k is the estimate. Chairman Powell's on a mission, Tom, to convince this market that the terminal rate's going to go higher. Even if they slow down, they're going to do more.
Are the vigilantes out there? And we're going to do this. Is going to be a little different, folks. We're doing the Jobs Day, and we'll do Michael McKee with all of his expertise, but we're going to fold the markets in the whole way. Are the vigilantes out today? The China vigilantes, the real yield vigilantes, the copper vigilantes, they're out today for Jobs Day.
Well, let's talk about crude and let's talk about China. The rumor mill in overdrive.
We just had a 98 print on Brent.
All week about
98.
China reopening, and it gets more fuel today. 98 on Brent, WTI just short of 92. We're up 4% on WTI crude today. And Tom, you've asked all year, imagine what this commodity market looks like if China came back online. Well, we're starting to price it in slowly. Let's see if we get any kind of confirmation from China whatsoever, because so far we haven't had much at all.
And that, Lisa, this is critical. That's a difference. Ed Morse earlier this week saying, no, we're not going to go to 120. Lots of demand dynamics there and supply dynamics as well. And Christian Malik over at JP Morgan says, baloney, China, Pacific Rim, up if they get the demand back.
And if that happens, what does that do to the global economy? What does that do to where end rates have to end? It's not just 2-year yields that are the highest since 2007. If you take a look over in Germany, 2-year yields there are the highest going back, or touch
Frame
the
that,
highest.
John, 2.14%. What does that mean?
But just this comes after ECB's Christine Lagarde actually came out and said they might actually have to have higher rates even still, echoing what Jay Powell said because of this concern about inflation.
Lisa, to your point, this started in Jackson Hole. At the end of August, you heard from an ECB executive, Isabel Schnabel. You heard from Chairman Powell, and they were both telling you the same thing. They're willing to cause pain. And in fact, the ECB is going a step further because they face the very near real reality of rolling into recession. And they're telling you they will keep hiking interest rates in that recession. So, Tom, it's different to what we've experienced before. And I keep asking the question for 2023. The number one question for 2023, if you expect economic weakness, do you expect the Fed to stand idly by and watch it play out? And that's going to be difficult.
Before we get to the data, we've got to look at the present news, which is tech austerity. Nick Turner with a great phrase over at Bloomberg Tech. But guys, I want to talk about the scariness, the layoffs, the Twitter thing, and all that. And is that separate and discrete from the job economy, or is it portend a path to 5% unemployment? I don't know the answer to that.
Let's strip out Twitter. It's its own beast.
Yes.
We can pick up on all the others, the chip makers, Qualcomm freezing hiring, Intel cutting jobs, cutting spending, all the above. You've seen that at Amazon. You've seen layoffs at Lyft, layoffs at Stripe. That was announced yesterday. We know that's where the excess has been in the tech sector. Not just the last couple of years, the last decade plus. So you know you need to unwind some of that excess. You're asking the right question. Is this a narrow story, or is it going to become a broader problem? And that's part of the conversation right now.
4.75% 2-year yield. That's the data point of the morning.
4.75, just unreal. 40 basis points 12 months ago. 40 basis points 12 months ago.
That's like, CD. You could get a 2-year CD and you're like, okay.
Get a 12-month
T-bill.
T-bill.
You do a data check? I'm trying to get you into,
right now.
Do the,
What's wrong with you?
Dow futures are up 181. Okay, there's your cue.
That's how you think I'm going to get the data check. Futures look like this on the S&P. We're 25 minutes away from the payrolls report. Futures are up 0.7%. We do the survey here at Bloomberg. The median, 195K. The previous number, 263. Unemployment, Tom, expected to tick a little higher from 3.5% to 3.5%. 4.6.
We had a briefing now. We go to the markets. Nadia Lovell joins us, senior U.S. equity strategist. Nadia, we've ignored this morning at UBS. Can you reaffirm an equity call for next year, or is the labor economy, the Fed economy, so uncertain you just really can't get out to, say, June of 2023? What's the call?
I think it's going to be difficult, but I think our message, Tom, has been quite consistent. We've been saying that this market is going to be choppier and lower for longer because it will be determined by how high the Fed go and how long it stays there. You know, I think what the market has been trying to suss out is whether we end up in a recession or not. And as we've been discussing this morning, the fixed income market does point to a high probability of recession. You've been talking about the deeply inverted 2-10 curve, but I think also, more importantly, watching that 3-month 10-year curve, which recently briefly inverted, and that tends to be a better indication of recession. And so it's just really difficult to see how this market bottoms before that if we do end up in a recession. It's just not typical historical trends. Market tends to bottom in a recession, not before recession. Even Chairman Powell this week admitted that the path to a softish language is quite narrow. And so if we think that, you know, if that happens, like we think that we've lowered our outlook for the S&P 500 to 3,700 for June of 2023. You know, there's risk to the downside. We see an earnings recession. I think it's just really difficult to be bullish in this market when you have a Fed that is laser focused on burning growth to suffocate inflation.
We've been talking all morning, Nadia, about the real rate. We've been talking all morning about two-year yields at 4.75%. And when you look at it on a relative basis with earnings yield in the S&P 500, it's looking more and more attractive. At what point have we fully priced in that reality versus really have to look at that real rate, that gravity that Tom talks about, as really driving further weakness ahead?
We think that there is further weakness ahead, you know, and if, as you noted, the fixed income market is looking more and more attractive. I mean, the equity risk premium has come in because of that. And so we do see more headwinds ahead to the market from a rate standpoint and valuation potentially coming in further. I mean, right now, you just have the forward PE in line with historical average. If we do end up in sort of a plain vanilla recession, that's likely going to put more downward pressure on a forward PE multiple. So we think that that's going to also keep a cap on the market. We don't think that all of it is behind us. Most of it is behind us, but there's still more to come.
Nadia, what part of the market do you think is further along in the adjustment process? And which part of the market would you lean into with that in mind?
You know, I think that obviously parts of housing is further along in that adjustment process. We have the mortgage rate now through 7%. And so that's going to also have larger implications to other sectors. And so we still think that there's some further weakness to come in consumer discretionary. Those markets that we continue to prefer here is the energy market. Of course, you've been talking this morning about the upward pressure to oil prices. We've been saying for quite some time that we think that Brent is going to get to $110. There's even risk to the upside now, especially if China comes back online. And then also the defensive sectors, we could continue to favor healthcare and consumer staples.
Nadia, if China comes back online, and we've had this discussion now for weeks, if they reopen, if they even give us a real hint that that's where this is going, is that good or bad news for the US market, given the Fed's going to have to lean harder into that?
It's good news for energy, maybe not so good news for the broader market because, yes, you know, we know that energy has been a source of inflation and that filters through the entire economy. And so that's going to make the Fed's job a little bit tougher. I mean, right now we're thinking that the terminal rates like peaks at 5.25%, but it could push higher, you know, if you see the commodity complex really rallies on China coming back online. And that's going to make the Fed's job a lot more tougher. So you could get to a terminal rate that's even closer to 6% if inflation does not abate.
Nadia, we're almost done with earnings season. What's your biggest takeaway so far?
I mean, so far it's been a quite underwhelming earnings season, quite disappointing. I mean, we've seen some high-profile misses, but what has continued to be clear to us that a slowdown is happening, particularly in tech. I mean, we've known for some time that there's been a slowdown in PCs and smartphone that is expanding beyond that, and also to data centers and gaming. We're seeing a slowdown in cloud computing as well, and some of the surveys are just pointing to weakness in overall tech. I think in terms of the consumer still remains fairly resilient, but it's becoming even clearer and clearer that spending continue to shift away from goods and towards services. And so we also, you know, the dollar. the dollar remains a key headwind here. I mean, we heard it from a lot of multinational companies, and that's something that we continue to watch closely, especially as the Fed remains the most hawkish central bank globally, and other central plans that terminal rates could potentially come down while our terminal rate is looking to risk to the upside.
That got highlighted this week, that's for sure. Nadia, thank you. Nadia Lovell there of UBS Global Wealth Management. We saw that in the space of 24 hours. Wednesday, the Fed Chair Jay Powell leaning into the idea that we could have a higher terminal rate. And then you had Governor Bailey, Tom, trying to push back against that idea that we'd have a higher terminal rate in the United Kingdom.
That's why this
bizarre.
And I may be off on this. I mean, I defer to our good guests, but to me, it's almost a 3-day jobs report. It's not about 8:30 this morning. It's about the continuum since Powell's stunned at the back end of that press conference.
So a 3-day news conference, let's say.
Yeah, I could go with
And then
that.
it's on to next week for CPI.
Well, yeah, and to your point, CPI, I mean, could it be a bombshell? I guess so. I don't know.
I would say it's a 12-month, jobs report. It's a 2-year jobs report. I mean, this is basically this rolling story that we keep getting wrong and surprised by.
What did Binky say yesterday?
It is.
Binky corrected me, and he said that it wasn't a continuation of the Jackson Hole speech in late August. He said it was a continuation of the March Federal Reserve meeting, and it's been going on for 8 months since then. Do you know how painful it feels to be that bullish on this market and see this Fed just eat it up,
eviscerate it
every single time he speaks at the moment?
What was it that you said? What was the 2-year yield 12 months ago?
40 basis
40
points.
basis
And then
points.
if you get Will Kennedy's
Regime
markets,
change.
you come right back with a China opening.
Yeah.
That pushes completely
You've
against
got
Chairman
another
Powell.
problem. Crude right now, just short of 98 on Brent, 91.50 on WTI. Futures just about positive, 0.7%, and yields higher, 475 on a 2-year. Payrolls, 20 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The monthly U.S. jobs report out in a few minutes from now, and the question is whether the labor market is cooling enough for the Fed. A Bloomberg survey says employers added 195,000 jobs in October, and it sees the jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point rate hike next month. Donald Trump has sent the strongest signal yet that he plans to run again in 2024. At a rally in Iowa, the former president said, quote, he is very probably will make another bid for the White House. Well, the rally was for Republican candidate Trump is backing in Tuesday's elections. Workers are suing Twitter over Elon Musk's plan to eliminate about 3,700 employees at the social media platform. Their lawsuit claims the layoffs are taking place without giving enough notice. The job cuts will amount to about half of Twitter's workforce. And a big sale for Airbus. China Aviation Supplies has agreed to buy 140 of the European plane makers' jets. The list price is about $17 billion. Although discounts are usually given for big orders, most of the planes are A320 single-aisle aircrafts. The announcement was made while German Chancellor Olaf Scholz was on a visit to Beijing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
So there's just a lot more momentum in the U.S. economy. Europe and the UK are dealing with a much bigger rise in energy prices, and they have a war on their doorstep. We don't think the unemployment rate's going to rise soon.
Dean Mackey there of Point72, the chief economist, and Tom, I think he hinted at modelling maybe what Aaron Judge the Queen's would look like.
No, he
for the
did
Mets,
not.
For the economy.
He
ran
away.
Deny it. Did he deny it?
He ran away. He was like, please.
I could see Steve Cohen's shadow behind him.
Yes.
Steve was just off to the right side
Seriously,
of the camera.
Bramo, don't ruin a good story. Futures up.
I'll try to
by
leave it.
0.6% on the S&P. Payroll's about 12 minutes away. We're looking for 195k. Equities up, yields higher by almost a basis point on a 10-year. 415 on 10s. If you just check out what's happening at the front end of the curve, and we've been doing that all morning, just to see the 2-year at 475, Tom, and now pushing 476 is quite something. We haven't seen these numbers since 07.
Yeah, it's interesting to say the least. And again, we're going to keep you in with the markets here as we move to this jobs report. Right now, when he's at Brown University, he would sit in the coffee houses of Providence and listen to all sorts of tasteful folk acts like Beveridge, Oken, and Taylor. Joining us now, Randall Krosner, professor of economics at Booth School, Chicago, and of course, former Fed governor. Randy, there's the chairman of the Fed citing in one sentence Arthur Oken, Beveridge of the London School of Economics, and I'm going to drag in the wonderful John Taylor of Stanford University as well. In this job economy that you confront in 10 minutes, does theory matter anymore, or are we making it up as we go?
Oh, I think theory still matters a bit, but this is a little bit unusual, let's say. We haven't seen the Fed raise rates so rapidly before. We haven't had coronavirus economy, and we haven't had inflation like this for 40 years. So I think theory still helps, but the data may be a little different than, and the underlying structure of the economy may be a little different than 40 years ago. Let's go to your wheelhouse, Newtonian calculus and its use in finance. What is the rate of change? And the second derivative we're observing right now, the rate of change of the rate of change, what do they signal to you? So I think what the Fed is looking for is really waiting to see whether the labor market is going to crack and find some cracks in the labor market. So far, the labor market has been very strong, really continue to create a lot of jobs, continue to have low unemployment rate, continuing to still have a lot of job openings relative to the number of unemployed people. And I think what the Fed would be looking for is some impact of its policies on the labor market. We've seen it in the housing market. The markets clearly now have gotten it that the Fed's going to be raising rates probably into the fives. That's why the 2 years at 4.75 where it is, and so that's why the job market now and the one that'll come next month will be so important for what the Fed does in December.
Randy, I want to pick up on that, what you just said there. The market has finally gotten it, that it took them a while, but they seem to have really received the message that the Fed is putting out there, that Fed Chair Jay Powell is putting out there. Is the message that rates are going to be above 5% for the bulk of next year? Is that the correct message as correctly being priced into the markets?
I think that's the reasonable likelihood. Now, obviously, how far, whether they will go above 5% and how far above will depend on labor market numbers now, next month, the inflation reports. But I think we're very likely to get probably 50 basis points at the next meeting, and then a continued rise through at least the first quarter of next year. That'll get us to a 5 handle. So I think, and as I've been telling you guys for a while, I think they're going to hold with a 5 handle through much of next year.
So how do we see this in the labor market? Because we're not expecting necessarily see it on the headline number. Perhaps we'll see it in some of the wages. But can you talk about where you see the layoffs happening? Do you think it is just going to be a tech-centric in some of these isolated areas, or do you think it's going to be a broader swath of layoffs that we'll start feeling perhaps by the second quarter of next year?
I think that's right. I think it will be broader. Right now the Fed is projecting a peak unemployment rate of 4.4%. That seems much too sanguine to me. If they really want to bring inflation down relatively rapidly, I think it's going to be very hard to have the unemployment rate just go up to 4.4%, because that's not much beyond where they see kind of the long run so-called natural rate level being. I'm going to get, Jay Powell has talked about pain. That means that there's going to be, I think, a higher unemployment rate, certainly with getting into the 5s and maybe even to the 6s. Although relative to previous slowdowns and recessions, that's still pretty good, but it certainly is a much higher unemployment rate.
Hey, Randy, wonderful to have you with us. Randy's going to stick around and break down the number when it drops. Randy Krosner there, formerly of the Federal Reserve. We are about 7 minutes away from the Fed decision. The number we're looking for is 193 now. That's changed in the last couple of minutes, so someone got in a late estimate to our survey. The median's 193. We're down from 263 in a previous month. That's the estimate relative to the prior number. Mike McKee sitting down pretty late this morning, Mike, for this jobs number. What are you anticipating?
Well, the whisper number's higher. The whisper number's like 238. So I think we're looking at the possibility of an upside surprise, and that's what everybody's going to be concerned about. If we get a low number, people will be happy because, as Randy just said, it would show the Fed is having an impact. But if we get a high number, then it's like, oh, the Fed has to do more work and we better reprice again.
You're so good at the mathiness and the data of this. You and Alec Tanzi. Who comes up with a whisper number?
Well, it's actually there's sort of two. There's the sort of social media one that goes around, but Bloomberg has an actual whisper number.
Bloomberg has an actual whisper. I did not know this.
WHIS Go, and people who
you can enter
are on the Bloomberg can enter your own number. So if you have a number you want to put in there,
I can do this.
You can do this.
Wow.
Well, Randy, and I know that you're here listening to this, and if the whisper is correct, and we do get a higher than expected number, does that change where you see the Fed going in terms of how much they have to do to really undermine some of the momentum?
So they're going to keep going until they see some slowdown in the labor market. And if that means, if we get a really strong number this month, we get a really strong number a month from now, inflation is still not coming down, they're going to be moving. They might even move 75 rather than 50, and they'll keep going until they start to see some signs of the slowdown in the labor market.
Mike McKee, I look at the jobs report, like layoffs at Lyft. I'm just happen to pick on Lyft here. When do they fold into this data? What's the lag before any given company's press splash actually is in the Mike McKee data?
Well, it's hard to know because you don't know how they're doing it. A lot of companies are letting people go, but they're doing it through attrition. And they're also looking at not hiring, they're cutting back on their hiring plans as opposed to actually laying people off. Now, if Elon Musk is going to fire 50% of his workers, that'll show up probably in a week or two in the jobless claims numbers, and in the total number of tech workers, it'll show up in another month.
Mike McKee breaking down the numbers for us in about 5 minutes' time alongside Randy Krosner. We'll catch up with Jeff Rosenberg as well. And Tom, that's the question we started the programme with this morning. We can all see it looking around, layoffs here, hiring freezes there. We can all see it looking around, inflation rolling over in certain places of this economy. We haven't seen it in the official statistics just yet.
Well,
and that's going to keep the Fed going.
Totally agree on the differences here and the importance of this number in 4 minutes. And I go to Dominic Kostum as an outlier, saying even now they're super restrictive as inflation comes down. That's an outlier call.
Equity futures right now up 0.6%. A yield higher by a single basis point, 416.26 on a 10-year, on a 2-year, through 475 this morning. The jobs number up next, the estimate 193,000. Payroll seconds away in the United States of America. Futures going into that number up 0.5%. Yields going nowhere on a 10-year, 414.79 with the jobs number. Here's Mike McKee.
We talked about an upside surprise, and an upside surprise is what we got. 261,000 jobs created. That is much higher than the 193 that was anticipated. And we get 233 in terms of private sector payrolls, which may be a little bit more important. The Fed is going to be more concerned with what private companies are doing than government hiring. The revisions, 29,000 positive from the prior months. So you add that together, and you got 290,000 jobs we didn't know existed before the month of October. Unemployment rate ticks up to 3.7 from 3.5. It was 3.7 in August, fell back to 3.5 in September. So 3.7, progress in the right direction in terms of unemployment as far as the Fed is concerned. Average hourly earnings, 4.7% on an annual basis after a 0.4 rise. The 0.4 rise a little bit stronger for the month of October, but 4.7 is bang on expectations, and that's also a move in the right direction. And the labor force participation rate falls, 62.2%. There's your answer, probably without me looking at it directly, for why the unemployment rate went up. So, John, how are people taking this?
Well, Mike, right now we seem to be trading on the upside surprise in the headline number and maybe not that unemployment story, but we can build that out. As you know, the first move, not always the right move when it comes to payroll, so we'll let this breathe, but I'll go through it as it stands. Equity futures now unchanged. They were positive on the S&P 500. We've talked a lot about the front end of the yield curve, the 2-year, up 7 basis points now, just short of 480. We came very close at 479.90. Yields up, stocks down, rolling over, and guess what's stronger? The US dollar. Euro dollar off the highs of the session, still positive by about 0.2%, but down from the day's highs of about 98.11, back down to 97.68. TK, it's an upside surprise on payrolls, and that seems to be driving things so far, and dare I say it, at least for now, and it might change in about 60 seconds' time, Tom, but at least for now, good news is, what is it, Tom? You can say it.
You're busting my chops here, but I'm looking at a market adjusting. The vigilantes are adjusting to a fully employed America, and I know what I just said there gets a lot of people upset. But
Tom,
that's the numbers I'm seeing.
Look, at the moment, we're trading on that headline figure. But Mike McKee, that 3.7% unemployment rate, if I'd just given you that and nothing else this morning, I wonder if we'd been having a different conversation at this time.
Yeah, I mean, people want to see the labor market slow down because they think that means the Fed is going to be able to do less or may not have to do more, depending on how you want to look at it. The underemployment rate ticks up as well. That's U6, 6.8 from 6.7%. And you look at the breakdown on an ethnic basis, which is what was the Fed's big thing before the pandemic, Black or African American unemployment, 5.9%. That's up from 5.8. Asian, 2.9, up from 2.5. And Hispanic, 4.2, up from 3.8. Throw in white, 3.2, up from 3.1. So every ethnic category saw an increase in unemployment during the month of October, which is kind of what the Fed sort of expected.
Well, but the other thing that is perhaps giving people pause is the month-over-month increase in wages, which actually came in hotter than expected at 0.4% versus the 0.3%. How much does this really underpin that the people who are getting jobs at higher wages than even people understand that they're getting? In other words, yes, there is a higher group of people who are just remaining completely out of the workforce, but those who are in are getting compensated more.
Well, they're getting compensated more, but it's not keeping up with inflation, so it's not helping. The question that the Fed is trying to answer or is afraid of hearing the answer to is whether or not people demand to keep up with inflation. So inflation's got to come down or wages have to go up or people are going to be rather dissatisfied. Now, as we fill in the holes in employment, that year-over-year number is starting to come down from 4.7. It was 5% in the month of September. It's coming down slowly. But the one thing I've noticed as I go through this report is that even with gains of 261,000, they're pretty widespread. The categories themselves, category by category, have slowed down some. Leisure and hospitality. Mike. Remember, we were getting hundreds of thousands a month. We get 35,000. And so you're starting to see some contraction there. Manufacturing, 32,000. That's still hanging in there. But construction, only 1,000 during the month. And that's kind of odd. I would expect that to go up just because of Hurricane Ian. Everybody's got to move to Florida and start rebuilding down there. There is no note that I see about Hurricane Ian in this employment report. It took place after the September one, but before the October one. So apparently it didn't have enough of an impact that it would be, here's a little bit of note, no discernible effect. That's what I was anticipating.
So there's the data, folks, as we digest this. I know 289,000 3-month moving average is the number I look at. John and I are looking at 4.77%, up 5 basis points in the 2-year yield. Randall Krasner knows these are abrupt moves. He mentioned that earlier. He is at the Booth School, the former Fed governor as well. Randy, you are a student of economic history. Let's say we get a terminal rate of 5.x%. Let's say we go back to CD rates of a time 20, 30, 40 years ago. Is it the same this time? Are we reverting back to a financial structure that we know, or are we in new territory?
I don't think we're going to be going back to interest rates at double-digit levels, which is where we were with when inflation was this high 40 years ago. So I don't think the Fed is going to need to go that high. But I think, as you can see with the 2-year moving up, the markets are saying, hey, this is a pretty strong employment report. We're not seeing cracks in the labor market yet. And so the Fed is going to have to continue on its path, and its terminal rate will be a bit higher than we thought.
What do corporations do? How do they adapt as we see the nominal yield and the real yield come up?
So that's, one of the things that the Fed's toolbox is to try to make financial conditions tighter, make it less attractive for firms to hire and less attractive to invest as hurdle rates go up, because both real and nominal rates would be going up, and that's their main tool for trying to slow the economy down and try to take some of the the excitement out of demand, and so supply and demand can come together without as much price pressure.
I said let it breathe, and we have done for a couple of minutes, and equities have raised the losses post-payroll. So the S&P 500 is back up higher by 0.8%. That move at the front end has faded back to basically where it was going into the print at 476, yields higher by 4 basis points or so. I don't think this is the game changer at all for anyone out there. And by the time we get to CPI November 10th next week, we won't even be talking about what's just happened here in the labour market, Tom. We're still waiting to see real cracks in that labour market to get a better understanding that the dual mandate of the Federal Reserve is in conflict. And right now for the Fed, it's not. I'm going to have this conversation with Rick Reeder over at BlackRock in just a moment, Anastasia Amoroso of iCapital, Mike Collins at PGIM, and we will catch up with Secretary Marty Walsh, Tom, of the Labour Department at this administration. Looking forward to that a little bit later in the next hour.
Very good. We'll continue with futures up 30. The VIX comes in 24.98. Lisa, gets my attention of a more buoyant market.
Yeah, and also the Fed funds rate was now pricing in a peak of perhaps 5.25% in June of next year, although that's fading a little bit as we start to go on. Randy Krosner, I'm looking at some of the details here, and this is actually a very confusing report to me. The unemployment rate now getting people's attention, perhaps, but the wage picture very confusing to me as well. What can you glean from the composition of jobs that perhaps are getting added or cut, and how that might be affecting the wage dynamic more than per se an entire inflation picture that the Fed can take away?
Sure. There's always one of the issues that you have to be careful about is exactly what you're pointing out, the so-called composition effect. What areas are seeing job increases more than others? Are those in general high wage or low wage areas? I haven't had a chance to dig into the details of the report, but that's obviously something one needs to look at. The Fed will be heartened that that we're not seeing an acceleration in the wage growth, that it's still around 4.7% where it had been. But it is hoping that is not going to rise, and it's hoping that it may come down a bit as they try to bring inflation down.
You know, I look at this, Mike McKee. I want you to jump in here, if you would, right now. I'm watching Mike, folks. Look at the real report, which is 10, 20, 30 pages long. Give it another number there for us and Professor Krosner. What matters to you?
Well, unemployment is what's been the interesting number today because it went up, and it's largely because of what we in the past would have said is bad news, but this time it is kind of what the Fed wants to see. In the household survey, the number of people employed falls by 328,000, while the number of people unemployed rises by 306,000. So a real difference between that and the establishment survey, which is not unusual, but it does tell you why the unemployment rate went up. We also had 22,000 people leave the labor force after 57,000 left the labor force the month prior. And so it's kind of interesting. It may be because kids have gone back to school and mothers have decided to stay home or something like that. But we're not seeing people drawn back in by the fact that there's so many jobs available.
Well, and Randy, that's where I wanted to really finish up here and just get your impression of why the participation rate is going down, why it is moving in the opposite direction, despite the wage gains and despite the job openings that we see in the JOLTS survey.
Yeah, this is one of the great frustrations that the Fed has, and Jay Powell's been talking about this for a long time, of trying to get, why aren't we seeing more people come back into the labor market? And I think it's a variety of factors. There are many of the older workers and more experienced workers are saying, hey, I know a lot of people who didn't make it through Corona. I want to make sure to have time with my kids, my grandkids. So you've seen a much lower labor force participation by older workers, and a lot of younger workers are saying, unless I can get a job where I can sit at home and kind of pick the hours that I want, I'm not going to bother to come in. And so it's hard, and despite all of these openings, it's not enough so far to be able to draw people in. Part of that is because even though wages have been growing nominally faster than they have in the past, the real wages, the inflation-adjusted wages, haven't been growing that strongly.
Randy Krosner, thank you so much for joining us. It's just a joy to have you with us on Jobs Day. He is at Booth School, London, and now back at Chicago as well. A headline that is out that gets us in front of our coverage that you will see Tuesday and Wednesday. Thrilled to bring you Bloomberg surveillance from the nation's capital for the election. Lisa, after the election, and this is from Mike Allen and the team at Axios, President Trump and his team November 14 to start a 2024 presidential run.
Not exactly shocking, considering that it is very,
particularly
very
the last 24
probably
hours.
likely that he's going to be running again. But it highlights how right after this midterm election, Tom, we are right into the presidential campaigning.
You're one of the days from November 8, 9, 10, 11, 12. Well, how's it going to change before we get to a supposed announcement from the former president? That again from Axios. Right now we go to Jeff Rosenberg, who was just wonderful on Fed Day, giving us the dynamics of a dynamic press conference as well. Maybe, Jeff, with BlackRock, maybe not as exciting as that press conference, but nevertheless, a job report of a fully employed America. From where you and your team sit, is this jobs report old news, present news, or indicate a buoyant future?
Yeah, great question, Tom. I think it validates what we think we know about this labor market, and that is that it is very, very slowly starting to show some effects of an economic slowdown, of the Fed's tightening. But go back to our conversation on the post-Fed day, it's all about the long and variable lags here. And so we're seeing, just the glimmers of what the Fed hopes to see in terms of the impact of their tightening this year, but it's going to take some time. And going back to what Lisa ended with Randy on, the most salient point I think here, and Powell mentioned it in the press conference, is the lack of labor force participation responding to this historic levels of openings. That's a huge disappointment. That's a problem because the economy is not responding to the Fed's tightening. And so they've got a lot more work to do. They're going to slow that pace, fine, but we really are not seeing the economic slowdown that's necessary for the Fed to get to that inflation slowdown. So this is a real challenge for the Fed and for the market.
Jeff, since you walked up to your TV set at BlackRock, and we said good morning on Bloomberg Radio as well, the two-year yield gave us a rounded up 4.76%. How does a grizzled pro like you adapt to yield, nominal, yield real, moving so fast and furious?
Yeah, you take what the market gives you, and in this market, it's been a dramatic increase and restoration of yield for safe assets. You think back to the zero interest rate policy environment, the negative interest rate policy environment, that gave us TINA. There is no alternative. Now there is an alternative. And so it's adjusting to where the opportunities are. The opportunities are in the very front end of the yield curve, where we're pricing in, as Lisa talked about a minute ago, 5.25% peak Fed funds rate. Whether or not that turns out to be the peak depends on inflation. But the Fed signaled earlier this week to expect an increase in that terminal rate. The market's already there. So there's not a huge surprise when we get to the S&P. There may be more of a surprise on the inflation next week, but there's a lot of opportunity there because we've done a tremendous amount of work pricing in the normalization, the tightening, the movement to restrictive policy that the Fed wants to be at and are getting much closer to being at.
Do you think that the balance of likely outcomes, Jeff, is more likely that we're going to see a higher than 5.25% Fed funds rate versus one that is below that in terms of where we end up at the peak?
Lisa, it's very tough to make that call because it's dependent on the inflation call. And what do we know so far about the inflation call? Everybody's gotten it wrong. Every time we get a surprise to the upside to the CPI, what happens to the inflation peak expectation and therefore the peak of the Fed funds expectation? We continually move it out. So very hard to see whether or not that's the peak. If the inflation forecasts finally show up, if we get that 0.3 in core CPI next week, then I think 5.25 will be the peak. But there is a possibility here, and you're seeing it a little bit in the data. The lack of the data today in the payroll report, the lack of an expanding labor force, very strong wages. is the risk of this alternative view that we are already in a wage price spiral. And if that's the case, then the Fed may have to do actually much more than that 5.25 that's currently priced in the market.
What does that do to risk assets, Jeff?
Well, I think it's a challenging environment for risk assets. We saw this in the post press conference equity market reaction, that the Fed doesn't want to see financial conditions easing prematurely. They need financial conditions. Remember, the transmission mechanism is tightened financial conditions, then it affects the real economy, slows the real economy, and then the slowdown in the real economy slows down inflation.
Right.
If the equity market gets ahead of that and eases financial conditions before the economy has a time to slow down and slow down inflation, then the Fed has to do even more. And that's why he pushed so aggressively back against that, oh, the market is up. What do you think about that? And then he gave you the greatest hawkish hits to push back down the market. So in that environment, it's going to be challenging for risk assets.
Jeff, Ian Lingen just publishes at BMO Capital Markets, always wonderful on fixed income, and he makes clear that this report gives Chairman Powell room to wait. He can now comfortably wait for these inflation reports that we see before the December meeting. Do you agree that it's not that it gives him degrees of freedom, but that this report gives him the room to really wait and analyze price change?
Yeah, I would agree that this report is not changing anything that we already have in the expectations for the Fed to begin a step down in the pace of the increases, but not necessarily ending that pace of increase until they start to see the development in inflation of a slowdown. So they can slow the pace because they want to incorporate the Brainerd perspective, long and variable lags, that important change to the statement that we got earlier this week. That's about the Fed acknowledging we don't want to go at 75 forever. We don't want to overdo it. We want to give time for the data to show up. And I think today's report is in line with that market expectation, doesn't really change it dramatically.
Are we going to go back to an era that was familiar over the past decade or so, where we finally grind through whatever this post-pandemic reality is and inflation gets back down to around 2% or even below that, and then we struggle with the same types of disinflationary forces? Or is this a materially different decade coming up?
Well, this is the premise of your question is, do we go back to the pre-COVID secular stagnation environment? And if you look at market consensus expectations for interest rates, for inflation rates, there is that expectation built into market consensus. We would be highly skeptical of that outcome. There are significant structural changes.
We got a little frozen there on Jeffrey Rosenberg. I guess we'll exit there. We're going to exit 30 seconds later, and we'll do it now. Thank you for that. In a frozanical moment with Jeffrey Rosenberg.
Frozanical?
It's a frozanical moment of it just, it happens there. You have that. And thank God to my left, I've got Michael McKee to save us before we go to Ira, Jersey. Are you going to freeze on us here?
I'm here in person, so I don't think so.
Well, so Mike, you've been having a couple minutes to really parse through some of the details. Anything stand out to you?
A couple of interesting things just that go along with the news lately. Joe Biden's been wanting the oil companies to produce more. Oil companies say they can't find workers. There's only 400 people hired in oil and gas extraction in the last month.
400.
Wow. 400.
A statistic in the report.
You're
That's
not
great.
going to get a lot done.
That's the granularity
in
of the
that
McKee
situation.
world.
And we're also getting into the holiday season. I was just in a store and I wanted to buy a Thanksgiving card. I couldn't because they're all Christmas cards. At this point, the retail trade only added 7,000 total, and department stores and general merchandise stores lost jobs during the month. And the interesting thing is warehousing lost jobs during the month. Couriers up only a little bit. Well, what I'm wondering is if this is a seasonal problem, a seasonal adjustment problem, in that when we had the pandemic, we all bought online. And that pushed up the numbers of people doing retail and especially the warehousing kind of numbers.
Yeah.
And now the seasonal adjustment factors are kind of off.
Yeah.
We've gone back, as Jeff Rosenberg said, to the pre-pandemic kind of hiring, and this may not be an accurate representation of where we are.
Michael McKee, thank you so much for bailing us out of a Frozanical moment. 10-year yield 4.18%. We had a 4.76 on 2-year, comes in a little bit, 4.74. Futures up 34, and the VIX under 25 shows the oddities of the equity market. Ben Emmons just publishes and makes very clear we will see 5% yields. Ira Jersey joins from Bloomberg Intelligence, looking at the short-term paper, but also out where Ben Emmons is looking as well. Ira Jersey, how does our listeners' and viewers' world change with a 5% 10-year and maybe with certitude a 5% 2-year?
Well, I think we get the 5% 2-year before we get the 5% 10-year for sure. And I think we're going to continue to see some yield curve flattening, because I do think that as we get higher and higher in terms of short-term rates and expectations that the Fed's going to hike now above 5%. We kind of thought 5% was going to be the ceiling, but this data just keeps on coming in way hotter than almost every forecaster is considering. As the Fed pushes against the rising inflation, we're going to have the long end just lag moves in the front end of the curve, and you're seeing that a little bit this morning, but not quite as much as I think that we'll get if we do see a pretty hot CPI report.
So how deep could this inversion be? We've been talking all day about the inversion in the 210 spread that goes back to 1982, and this question of what kind of depth of recession that portends. How deep could that inversion go?
Yeah. So our forecast had been for negative 65 basis points on the 210s curve. We were, kind of approaching those levels. But I think if the Fed's going to go higher and above 5%, then that inversion just starts to get larger and larger. So let's imagine a situation where the Fed actually goes above the 5.25, that's the market's currently pricing, and goes to 5.5. I think you can end up with at least a negative 75 and maybe even a negative 100 inversion in the 210s curve, which it's not unprecedented. We saw even a deeper inversion back in the 1980s, but the point is that the higher short-term rates go, probably the deeper that inversion gets. It doesn't mean that we won't see, Ben Emmons' 5% 10-year yield, but I think you get there if, say, the Federal Reserve hikes to 6%, for example. So that's kind of the ratio. Call it a 50% beta between 2s and 10s, I think.
Ira, so many watching and listening have never experienced negative 75 basis points on the vanilla spread. What does that do to the banking system? Is that glory days for Brian Moynihan and Jamie Dimon in the banking industry?
Well, I think in the past, when banks did a lot more maturity transformation type of trades and borrowed short term and then lent long term, it mattered a lot more. It matters a little bit less now because some of the Basel regulations have significantly shifted the way that banks do their business, and they actually issue a lot more debt in term space. So it's a little bit less important than it used to be. Now, it still matters because there still are things like deposits. But the other thing that banks are, if you look at bank deposits as their total funding, it's a lot more, and banks just aren't increasing the amount that they pay, the interest that they pay on deposits as fast as the Federal Reserve is increasing the interest rate. So banks are just still taking advantage of that maturity transformation, and NIMs haven't come down that much.
Ira, 10 seconds. Tottenham or Liverpool this Sunday? What do you think?
Oh, Liverpool has not looked good the last couple of weeks. I'm going to give the edge to Tottenham.
There we go. You can come back. Ira Jersey, thank you so much. Bloomberg Intelligence. We need to switch to the equity market because the bond market, front and center, is out front in terms of rates of change, but the equity market's there.
Sort of, and that's a question of whether the equity market is getting what the bond market is getting and whether the messages somehow are missing each other in transit. Gina Martin-Adams joining us, Chief Equity Strategist for Bloomberg Intelligence. Is this labor market report good for stocks the way that it seems to be, at least in the knee-jerk reaction?
I think it's a net neutral for stocks, Lisa. I mean, I think it confirms what we already know. That is that labor markets are still relatively tight, wages are still relatively fast. Maybe the equity market is taking some solace in the idea that the unemployment rate started to tick up, and that might lead to more weakness going forward. But I think it's a net neutral report, frankly. Think about where we were earlier this week on the equity market. There's been a lot of volatility in the interim, so I wouldn't attribute all of today's move to this report specifically.
Gina, we don't have much time, so I want to ask you with immense respect for the hundreds of people that you work with in the equity space, where on the income statement coming out of Q3 into this absolutely historic time, where in the income statement is your team studying the most? Top line down to the bottom line. What's the mystery?
The most important point to watch in terms of the broader equity market fundamentals is the operating margin line. Operating margins always trough before the earnings trough. Operating margins will always give you a clue as to when you're at your worst point in time. This is incredibly important and actually related to the labor market data that we're getting today, because many S&P 500 companies are producing negative operating margin growth on a year-ago basis. They're seeing operating margins fall. But also several S&P 500 companies over the course of this earnings season have announced layoffs or job freezes. So the index is always going to be in front of what you get on in the economic news, and we are starting to see companies react to operating margin weakness through job cuts, or at least freezes to their labor force. So you will see operating margins finally trough before we start to get some recovery in earnings. We think that trough may come as early as the first quarter. That certainly is what's in analyst expectations, but there's a lot of volatility in the interim.
Gina, we've got to leave it there. Gina Martin Adams, thank you so much. And we'll look at that operating income analysis across Bloomberg Intelligence here in the coming days and weeks. Lisa, I've never seen 3 days like this. There's been some joy along the way. August of 1998, some early things in the 90s, et cetera. These 3 days, cumulative to the press conference, the ballet in London, and what we just witnessed today, it's the most unusual time.
I think framing it out, the idea of a 40 basis point 2-year yield 12 months ago to now like going to 4.75%, 4.73% highlights the regime shift and the unique moment that we're in, that suddenly everything has to reset at a new level. And the question is, what does that look like? And when do we understand the contours of that new reality?
I mean, we will see. And then, of course, to Washington next week.
Well, yeah, and to Washington in about a half an hour coming up at 9:30 a.m. Eastern. We do hear from Marty Walsh, U.S. Labor Secretary on Bloomberg TV and Bloomberg Radio. How do they really talk about a labor market still very strong when everyone talks about inflation being the foremost problem and you need to have a different scenario in the employment market? From New York, this is Bloomberg.